To order, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of the Financial Stability Oversight Council. Today we have 8 of the 10 voting members as witnesses today. Secretary Liu has testified according to statute earlier in the year, and Chair Yellen has regrettably declined to give testimony today. I now recognize myself for 3 minutes to give an opening statement. Financial regulators possessed every regulatory power necessary to prevent the 2008 financial crisis, but failed to do so. Yet Washington rewarded them with vast new sweeping powers over our lives and our economy. Nowhere is that more evident than in the Dodd-Frank Act's Financial Stability Oversight Council, whose members, again save 2, sit before us today. FSOC is clearly one of the most powerful federal entities to ever exist, and unfortunately, also one of the least transparent and least accountable as well. First, the council's power is concentrated in the hands of one political party, the one that happens to control the White House. All but one of its members is the presidentially appointed head of an agency, but interestingly, the agencies themselves are not members, thus denying bipartisan representation. This structure clearly injects partisan politics into the regulatory process. It erodes agency independence and harms accountability. Furthermore, FSOC's budget is not subject to congressional approval, removing yet another check and balance to its immense power. FSOC has earned bipartisan commendation for its lack of transparency. 2/3 of its proceedings are conducted in private. Minutes of those meetings are devoid of any useful substantive information on what was discussed. Even Dennis Kelleher, the CEO of the left-leaning Better Markets, has said, quote, FSOC's proceedings make the Politburo look open by comparison. At the few open meetings they have, they snap their fingers and it's over. They are all scripted. They treat their information as if it were state secrets, unquote. Of all the council's activities, none generates more controversy than its designation of non-bank financial institutions as systemically important financial institutions, or SIFIs by acronym. Designation anoints institutions as too big to fail, meaning today's SIFI designations are tomorrow's taxpayer-funded bailouts. Designation also ominously grants the Federal Reserve near de facto management authority over such institutions, thus allowing huge swaths of the economy to potentially be controlled by the federal government. Members of the council can merely raise the prospect of a SIFI designation and thereby eliminate entrepreneurial risk-taking, innovation, and growth from our economy. As a result, Americans may find themselves paying more to insure their homes and their families. Investors who relied on mutual funds to save for their children's education or their own retirement will find they have earned less. In addition to SIFI designations, FSOC is charged with identifying emerging threats to our financial stability, but refuses to look in the mirror. In its latest annual report, it conspicuously omits any references to specific government policies or agencies as helping cause the systemic risk it identifies. Quote, greater risk-taking across the financial system is encouraged by historically low yield environment, the council reports, yet the council refuses to identify the obvious source of this apparent risk, the Fed's unprecedented loose monetary policy. The council warns of reduced liquidity in the capital bond markets, yet never acknowledges that Dodd-Frank's Volcker Rule and other regulations have drastically reduced liquidity. The council lists risk-taking, large, complex, interconnected financial institutions as a threat. Yet again, it fails to mention that Dodd-Frank amplifies this threat by empowering the council to designate certain firms as too big to fail. FSOC typifies not only the shadow regulatory system, but also the unfair Washington system that Americans have come to fear and loathe. Powerful government administrators, secretive government meetings, arbitrary rules, and unchecked power to punish or reward. Thus, oversight and reform is paramount. I yield back. The chair now recognizes the gentleman from New Jersey, chairman of our Capital Markets Committee, Mr. Garrett, for 1 minute.
I thank the chairman. I thank all of our witnesses here today. And I guess all of our witnesses, you all have gotten to know each other pretty well because you meet regularly in closed-door sessions where the public is not allowed to basically discuss to fundamentally change the U.S. economy. So I thought I'd just take this minute to introduce ourselves to you. We're the U.S. Congress. We were created by Article 1 of the U.S. Constitution. We're the ones who are actually elected representatives of the American public. And we're the ones who send you all those pesky letters that you all routinely ignore And I know you're probably confused by this setting, that the public is here, that there's TV cameras here, so this is probably unusual for you, but this is what we do. We're open to the American public, we are transparent, and we are before the American public. So if there's one thing that you take away today, and that's the way you run your hearings, and that's the way you conduct yourselves, you need to become more like us, more transparent, more open to the American public, more showing what your agencies are doing, and adopt these policies so that you are no longer working behind closed doors and in secret. With that, I yield back.
Chair now recognizes the ranking member for 5 minutes.
Thank you, Mr. Chairman, and thank you to the distinguished members of the Council for joining us for this hearing. We gather today to examine the activities of the Financial Stability Oversight Council, or FSOC, which, since the passage of the Dodd-Frank Act, has fulfilled its mandate to monitor and respond to the types of systemic risks that nearly brought our economy to its knees in 2008. This important work cuts across every corner of our banking, capital markets, housing, and insurance sectors, which is why Congress specifically designed the Council to draw upon all of the expertise of the witnesses here before us today. Unfortunately, many of my colleagues on the other side of the aisle seem to have caught a convenient case of amnesia about this important mandate. Indeed, it was only 7 short years ago that our economy lost nearly $16 trillion in household wealth, $13 trillion in economic growth, and 9 million jobs. In large part, this was because our regulators were too often caught in silos, not communicating with one another and not considering gaps between their agencies or interconnectedness within the financial sector. Even worse, we saw too many cases where regulators were captured by the very entities they were meant to police. Many of these lessons appear to be forgotten, as we have seen with recent markups, as well as attempts to laden government funding bills with poison pill riders. Some opponents of Dodd-Frank are far too focused on dismantling Wall Street reform by attacking core elements like the FSOC and the Consumer Financial Protection Bureau. These attempts to roll back Dodd-Frank started the minute this reform was signed into law. And make no mistake, these attempts continue today, even as our economy has experienced a remarkable rebound with 69 straight months of positive job numbers, GDP growth, and a housing market where sustainable access to credit continues to expand, all of which are signs pointing to the sort of stability and growth that the law was designed to promote. FSOC has contributed to this growth and stability by convening the 10 component regulatory agencies for periodic information sharing about emerging risk and reporting on those risks to the public. Further, the Council has now designated 4 institutions for enhanced supervision by the Federal Reserve. This designation will ensure that companies like AIG never again are able to engage in risky, unregulated activity that could threaten the entire global economy. And far from the talking points of some members on the opposite side of the aisle, this enhanced oversight is now causing some large non-bank financial companies to consider whether simplifying their structures and breaking themselves up might provide better value to their shareholders. I'm also encouraged that the money market fund industry is now less susceptible to bank-like runs as a result of the pressure the FSOC brought to overcome gridlock at the Securities and Exchange Commission. Finally, I appreciate that the Council has made an effort to conduct this work in a manner that is responsive to feedback from Congress and outside stakeholders. For example, with this announcement in February, the FSOC took the step of voluntarily agreeing to certain due process and transparency measures that will further serve to improve their operations. This type of dialogue and openness to feedback should be applauded. As we hear from the voting members of the council today, I will be interested to learn more about their interagency collaboration and their work to address emerging threats. Again, this work is central to preventing the types of contagion and risks that nearly crashed Main Street just 7 years ago. Thank you, Mr. Chairman, and I yield back the balance of my time.
Chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, Chairman of the Housing and Insurance Subcommittee, for 1 minute.
Thank you, Mr. Chairman. An inefficient and secretive regulatory structure that does not reflect the reality of the U.S. financial system can have real economic consequences for businesses and the American people. This is particularly true of the banks that have been deemed to be SIFIs, not based on risk posed to the U.S. financial system, but purely on arbitrary asset size. On the non-bank side, designations are part of the shadow regulatory system that has become synonymous with the overzealous enforcement climate so prevalent today. The unbridled power of FSOC should alarm all Americans. Judging by what we know of the staff hours spent on non-bank analysis, which we'll get into shortly in the question and answer period that I have, it's clear to me that these designations and the lack of a clear path for de-designation is a Federal Reserve-driven effort to expand government's power and influence. It's time to force more transparency, to require pragmatic regulation, and to curb the growing regulatory regime crippling our institutions and their customers. With that, Mr. Chairman, I yield back.
Gentleman yields back. Today, we welcome the testimony of the Honorable Mary Jo White, Chair of the Securities and Exchange Commission, Timothy Massad, Chairman of the Commodities Future Trading Commission, Roy Woodall, the FSOC's independent member with insurance experience, Debbie Matz, Chairwoman of the National Credit Union Administration. An especially warm welcome to our former colleague, Mel Watt, Director of Federal Housing Finance Agency, Martin Grunberg, Chairman of the Federal Deposit Insurance Corporation, Richard Cordray, Director of the Bureau of Consumer Financial Protection, and last but not least, Thomas Curry, Controller of the Currency. Since all of our witnesses have previously testified before Congress, I believe they need no further introduction. Without objection, your written statement will be made part of the record by agreement with the ranking member. Each of you will be recognized for 3 minutes to give an oral presentation of your testimony. Chair White, you are now recognized.
Thank you. Chairman Henserling, Ranking Member Waters, and members of the committee, thank you for inviting me to testify regarding the Financial Stability Oversight Council. As you know, the Dodd-Frank Act established the Council to provide comprehensive monitoring of the stability of our nation's financial system. It also provides a formal forum for coordination among the various financial regulators, assisting in bringing about the kind of collaborative sharing of information and concerns that, in my view, is very important to safeguarding the U.S. financial system. As one of 2 capital market regulators on the Council, the perspective that I and the SEC staff bring to the Council is important. In particular, the SEC's historical tripartite mission of protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation necessarily gives the SEC unique insight into many areas on which the Council is focused, such as the potential financial stability risks of asset management activities and products, the ongoing changes to market structure, and the role of central counterparties. SEC engagement with the Council on these issues helps to ensure that relevant expertise is brought to bear on these important subjects. With respect to designations of any non-bank financial companies as systemically important, I believe it is important to be data-driven and to conduct rigorous analysis throughout the process. The Council is also focused on enhancing its process and the transparency of its functions, which I consider to be quite important. Toward that end, as the ranking member indicated, in February of this year, the Council unanimously adopted changes to the designation process, including increased and earlier engagement with companies under review, increased public transparency concerning the designation factors, and an opportunity for designated firms to meet with Council staff in connection with the annual review of their designations. I look forward to our continued study of possible further enhancements and agree with the observation that the Council is a relatively new organization and should continuously study ways to optimize its functioning. Thank you again for the opportunity to testify today. I would be pleased to answer your questions.
Chairman Massey, you are now recognized.
Thank you, Chairman Henserling, Ranking Member Waters, and members of the committee. I appreciate the invitation to testify today. The CFTC oversees the U.S. derivatives markets, and although most Americans do not participate in these markets, they are vital to our economy, affecting the prices we all pay for food, energy, and other goods and services. For these markets to work well, sensible regulation is essential. We learned that lesson in 2008, when a lack of oversight led to a buildup of excessive swap risk that contributed to the worst global financial crisis since the Great Depression. My perspective as a member of the FSOC is shaped by my responsibilities as CFTC chairman, and today I would like to highlight a few of the CFTC's priorities that are particularly relevant to the FSOC. First is the implementation of a regulatory framework for over-the-counter swaps, where we have made great progress. And a number of financial regulators have responsibilities in this area, and the FSOC provides a useful way to communicate. A second area is making sure clearinghouses are strong and resilient. While we are the primary supervisor of clearinghouses in the derivatives markets, we work together with the Federal Reserve, FDIC, and SEC on these important issues. The CFTC has taken many actions to strengthen clearinghouse resilience, but there is more work to do in this area. Another priority of the FSOC and CFTC is strong, resilient markets. And following the volatility in the Treasury market on October 15th of last year, the FSOC served as a forum to share information. Shortly after the events, CFTC staff provided a preliminary analysis of what happened in the futures markets to the Council, and subsequently, we worked with other FSOC members to prepare a detailed report analyzing what happened. Together, we continue to look at these issues pertaining to the evolution and oversight of these markets. In addition, cybersecurity is one of our agency's top priorities and one of the greatest risks to our financial system today. And here again, the FSOC plays an important role in facilitating cooperation. Another area of focus for the CFTC that is important to FSOC is the oversight of benchmarks. Integrity of benchmarks is critical and has been a priority in our enforcement efforts. One of the most valuable functions of the FSOC is simply to bring together the agencies and regulators responsible for oversight of our financial institutions and markets. I believe doing so better positions us to identify and address potential threats to financial stability and better serve the American people. Thank you, and I look forward to your questions.
Mr. Woodall, you're now recognized.
Thank you, Mr. Chairman, Ranking Member, and members of the committee for inviting me to appear before you today. Mr. Chairman, you've asked that we be succinct in our oral testimony this morning, and the committee received my written testimony last Friday morning, and in view of your request, I do not feel it's necessary for me to expound on it in detail. But in short, as the committee examines ways to improve the structure and the operations of the Council, my written testimony discussion falls into three broad categories. First, the background and legislative history of the independent member position in Dodd-Frank. Second, the lack of explicit statutory duties and authorities pertaining to the position, other than just being a member of the Council, and the difficulties that has presented from being only, quote, 3 lines in the statute. The first line creates the position, second one sets the 6-year term, and the third one sets the salary. That's all that's in Dodd-Frank about my position. Finally, the third section of my written testimony tries to go into my willingness to work with Congress on how the role and authorities of the position can be clarified to strengthen the independence of the position in order for the holder of this position to be more effective in contributing to the work of the Council. Thank you. I'm happy to answer any questions.
Chairwoman Matt, you are now recognized for your testimony.
Thank you.
Sir, if you can hit the button, please.
Thank you, Chairman Henserling, Ranking Member Waters, and members of the committee. I appreciate the opportunity to discuss the Financial Stability Oversight Council. Congress established the Council in response to the 2008-2009 financial crisis. The crisis made clear that financial markets cannot quickly absorb the collapse of very large, interconnected companies. FSOC's primary goal is to prevent system-wide financial crisis. The Council's multi-agency structure also ensures that a diverse array of views on emerging risks in each financial sector is considered when making decisions. From the beginning, the Council has recognized the importance of transparency and public participation. The Council committed to publicly disseminating timely information about decisions while balancing the need to protect proprietary information and avoid unduly moving markets. Public feedback has also helped EFSOC clarify procedures, enhance analysis, and improve decision-making. As an EFSOC principal, I'm committed to continuing such improvements. Each council member brings to the table a unique perspective informed by our areas of expertise and experiences. As a federal financial regulator for almost 10 years, I lead an agency that now supervises and insures more than 6,000 institutions with assets exceeding $1.1 trillion. Financial institutions of every size must carefully manage assets and liabilities. In fact, major elements of EFSOC's designation of a systemically important institution include the composition of the balance sheet, off-balance sheet exposure, and interconnectedness with the entire financial services sector. EFSOC has moved deliberately in creating its process for identifying non-bank financial companies. In response to public comments and congressional feedback, the Council has also invited company participation earlier in the process. Another important aspect of EFSOC's work is its annual report. The 2015 report called for heightened risk management and supervisory attention in areas such as cybersecurity and reaching for yield. In conclusion, EFSOC has promoted collaboration across financial regulators, established rules and procedures which reflect public input, identified systemically important institutions, and furthered public awareness of threats to our financial system. Going forward, the Council must continue to evolve, provide transparency, and remain flexible when considering new issues. I look forward to your questions.
Director Watt, you are now recognized for your testimony.
Chairman Henseling, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify today about the Financial Stability Oversight Council and to be back before this committee on which I served for 21 years. As an independent regulator, FHFA is responsible for the supervision, regulation, and housing mission oversight of Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system. In addition, since 2008, FHFA has served as conservator of Fannie Mae and Freddie Mac. FHFA's housing finance market expertise contributes to EFSOC's ability to understand and better assess broad systemic risk. As I recall, ensuring that FHFA contributed this kind of expertise to EFSOC was especially important to Congress, both because housing represents a significant part of our economy and because the most recent severe disruption of our economy that our economy experienced resulted from business entities and others making unsafe and unsound housing and housing finance decisions. Through FHFA's active participation in all EFSOC committees, FHFA engages regularly with other EFSOC members to share information, evaluate policy matters, and conduct risk assessments of business entities and markets in which they operate. FHFA also participates with other members of EFSOC in making assessments of whether to designate non-bank financial companies for supervision by the Federal Reserve. If so designated, these companies are required to meet enhanced prudential standards. This is a significant and important EFSOC function, and it is one that all EFSOC members, including myself, take very seriously. These decisions are made only after extensive engagement with the company, a thorough analysis of the facts, and careful deliberations. Going forward, I look forward to continuing to engage with fellow EFSOC members to meet our duties and responsibilities in a manner that fosters transparency, is fair and analytical, and contributes to appropriate risk management and risk reduction. I will limit my comments to these statements, and I look forward to answering your questions today.
Chairman Goomberg, you are now recognized.
Chairman Hensarling, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify today on the work of the Financial Stability Oversight Council. The financial crisis that began in 2007 exposed a number of serious vulnerabilities in the U.S. financial system. While some risks affecting individual products and institutions had been recognized, neither the financial markets nor the regulatory community was able to see the whole picture. The FSOC was established in 2010 by the Dodd-Frank Act to address this gap in the regulatory framework. Its key functions are to facilitate information sharing among its member agencies, to identify and respond to emerging risks to financial stability, and to promote market discipline. The FSOC is also responsible for designating non-bank systemically important financial institutions for heightened supervision by the Federal Reserve. We now have the benefit of 5 FSOC annual reports, which together outline the key systemic risks facing the financial system and how they've evolved over time. The first report, published in 2011, described a still fragile financial system recovering slowly from the deepest financial crisis since the Depression. In contrast, the most recent report describes a more stable, though still recovering economy and broad-based improvement in most financial markets and market participants. 3 broad areas of risk which the FSOC has been following closely and which are of particular consequence to the FDIC are interest rate risk, credit risk, and cybersecurity, which are expanded upon in my written statement. As previously noted, the Dodd-Frank Act also authorizes the FSOC to designate a non-bank financial company if the FSOC determines that material financial distress at the company or the nature, scope, size, scale, concentration, interconnectedness, or mix of activities of the company could pose a threat to the financial stability of the United States. FSOC policies and procedures were crafted to ensure an exchange of information throughout the designation process. As the process has evolved, opportunities for additional transparency, both within the operations and the designation process, were identified by the FSOC and in comments by external parties. As a result, the FSOC undertook several initiatives over the past year and a half to improve both transparency and engagement with financial companies. These steps are outlined in my written statement. Mr. Chairman, that concludes my oral statement, and I'll be glad to respond to questions.
Director Cordray, you are now recognized for your testimony.
Thank you, Chairman Hensarling, Ranking Member Waters, members of the committee, for the opportunity to testify today. I'm glad to work with you and with my colleagues on the Council to strengthen our financial system. As we're all aware, just a few years ago, disruptions in the housing market preceded a financial crisis that caused significant damage to our people and our economy. The ensuing deep recession caused millions of Americans to lose their jobs, millions of families to lose their homes, as the ranking member noted. Many saw their retirement savings diminished as Americans lost trillions of dollars in household wealth. Severe deficiencies in the loans supporting mortgage-backed securities in particular created shocks that upended the financial system. In the aftermath of the crisis, Congress passed financial reform legislation to address the problems that led to the crisis and help ensure they would not happen again. Among the steps taken were the creation of the Financial Stability Oversight Council and the Consumer Financial Protection Bureau. The creation of the FSOC provides for the first time a means of comprehensively monitoring the stability of our nation's financial system. Prior to the crisis, the U.S. financial regulatory framework focused more on individual institutions and individual markets in isolation from one another. No one regulatory body was responsible for monitoring and addressing overall risks to financial stability, which too often involve different types of financial firms operating in complex and intertwined ways across multiple markets. The potential for supervisory and regulatory gaps were viewed as creating blind spots in important parts of the financial system. After the crisis, Congress recognized the need for a mechanism to bring financial regulators together to monitor the financial system, share information and expertise, and coordinate their regulatory efforts to respond effectively to emerging threats to financial stability. One approach that Congress specified to address these issues was to designate certain financial institutions and financial market utilities as systemically important to the stability of the U.S. financial system for the purposes of applying enhanced prudential standards and supervision. As you know, the FSOC includes the Consumer Bureau, which is the first federal agency solely focused on protecting consumers in the financial marketplace. Products such as mortgages and credit cards are involved in some of the most important financial transactions in people's lives. These products are often funded through complex financial markets, and they may constitute the underlying assets for more complex and highly leveraged securities. As the crisis made clear, financial stability, market discipline, and consumer protections are closely interrelated. Part of the mission of the Consumer Bureau, therefore, is to help ensure that the recent economic meltdown is not repeated. The practices that led to the financial crisis are inconsistent with principles of fairness, transparency, and competitiveness in markets. We are exercising the authority Congress gave us to ensure balanced oversight and prevent harmful practices in consumer financial markets. When honest and innovative businesses can succeed on the merits, fair competition drives growth and progress, and the entire financial system rests on stronger and sturdier foundations. As a director of the Consumer Bureau, I look forward to continuing to fulfill Congress's vision for our agency and my role in the FSOC. That's what we're here today working together to do. Thank you again for the opportunity to testify, and I look forward to your questions.
Comptroller Curry, you are now recognized for your testimony.
Chairman Henserling, Ranking Member Waters, and members of the committee, thank you for this opportunity to provide the views of the OCC on the functions and operations of the FSOC. The OCC charters, regulates, and supervises national banks and federal savings associations. These banks range from small community banks to multi-trillion-dollar institutions that are among the world's largest financial companies. Together, they hold nearly $11 trillion in assets, or just over 2/3 of the industry's total. The OCC's mission is to ensure that these banks operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. As the only federal financial regulator with prudential regulation as its primary focus, the OCC has specialized knowledge about the safe and sound operations of banks. In 2010, as part of the Dodd-Frank Act, Congress established the FSOC to identify, monitor, and to respond to systemic risk. The Council brings together its member agencies to fulfill this critical mission. Through its committees and staff, the FSOC provides a formal, structured process for communicating, coordinating, and responding to emerging market, industry, and regulatory developments, as well as to unforeseen events. As one of the FSOC's 10 voting members, the OCC brings considerable expertise to the Council. Our examiners monitor several areas of financial risk in the banking sector every day, including credit, liquidity, interest rate, and operational risk. These are among the risks that the FSOC reviews in its evaluation of systemic risks with respect to non-bank financial companies and financial market utilities. Similarly, as many of the institutions we supervise are engaged in asset management activities, the OCC's expertise in this area is also quite robust. Since its establishment, the Council has demonstrated a sustained commitment to working collaboratively to fulfill its statutory mission. Council members and their staffs have developed strong working relationships, and the Council provides a constructive forum to hold candid conversations, share confidential market-sensitive information, and to ask the tough questions that help make the U.S. financial system safer. The Council has also made positive strides in enhancing its transparency both to the general public and to the companies under consideration for designation. Dodd-Frank provides the FSOC with important duties and responsibilities to promote the stability of the U.S. financial system. The issues that the Council confronts in carrying out these duties are, by their nature, complex and far-reaching. My written testimony includes additional information about the specific mandates Congress has given the FSOC and a discussion of some of the important actions the Council has undertaken recently. For our part, the OCC is strongly committed to helping the Council achieve its mission. Again, thank you for the opportunity to appear today, and I would be happy to answer any questions.
Chair now recognizes himself for 5 minutes for questions. By show of hands, how many of you have any professional experience in the private insurance industry? Please raise your hand. I see two, Mr. Woodall and Ms. White. Let the record reflect that. How many of you have had experience in regulating insurance companies? By show of hands, please raise your hand. Let the record reflect only Mr. Woodall raised his hand. Mr. Woodall, as FSOC's independent member having insurance experience, you dissented in both the MetLife and Prudential SIFI designations. In your dissent to the designation of MetLife, you wrote, quote, "It confounds me that much of the council and staff continue to misunderstand and mischaracterize the insurance regulatory framework." You went on to say that FSOC's analysis, quote, "relies on implausible contrived scenarios as well as failures to appreciate fundamental aspects of insurance and annuity products, and importantly, state insurance regulation and the framework of the McCarran-Ferguson Act." Do you still stand by those comments?
Yes, I do, Mr. Chairman, and if I could expound just a little bit the basis of all of that and put it in perspective, is that I was pointing out that under the statute, there are two determination standards under which the council comes up with its idea that a company is a SIFI. And the first one is the only one that's been used so far, and that is if there is a material financial distress at that individual company, which could be a threat to the entire U.S. financial system. The other is activities. Are there activities that could be a threat? My push has been to get the second standard of activities to be used across sectors so we can get at the very things that are causing the systemic risk across sectors. If we've got a situation where if we've got a company that's a SIFI and it knows that it's doing an activity that's systemically risky, it can sell that activity to somebody who's not a SIFI, and then essentially we've lost them. They're there, but the risk and the systemic risk could still be in the system.
Well, Mr. Woodall, what are the implications of designating a traditional insurance company SIFI? Since they're already under state-based regulation, we will have a duplicate regulatory system. Do you believe that those costs could be imposed upon policyholders and insurance company investors? In other words, what's the harm in designating a traditional insurance company a SIFI?
Well, I think there's a harm. It could come to higher prices because they've got higher regulatory costs. And also with a higher regulatory cost, their products have to be priced higher, as I said, and that costs more. But it also puts them in an unlevel playing field with the people and the companies that are not designated SIFIs.
Chairwoman Matz, prior to voting to designate Prudential as a SIFI, did you make any inquiries or request any type of economic analysis on what this designation could mean to insurance policyholders? Was that part of your decision-making process? I'm sorry, if you could hit the...
No, it was not.
It was not. Do you believe it should have been?
That was not the mandate that we had. The mandate is to determine if material distress at a non-financial institution could cause, could pose an emerging threat to the stability of the United States.
Okay, under Section 113A2 of Dodd-Frank, there are 11 different factors you are to consider in making your designation. With respect to the Prudential decision, to what extent did the leverage of the company play a role in your decision to designate it as SIFI?
It was the combination. We were briefed extensively on the financial. And
I'm sorry, briefed by who?
Briefed by the FSOC staff and the NCUA staff that works with the FSOC staff, that participates with them.
So does the NCUA staff have expertise in insurance company leverage? What was the specific leverage of Prudential that caused you concern?
The determination wasn't based on the insurance activities. It was based on the financial activities of the company and how they are interwoven with other...
And specifically, which activities were those that were interwoven that concerned you?
Well, it was their derivatives position, the extent of their leverage.
But I asked you about the leverage.
The securities lending, their debt position, the difficulty it would be to resolve them if there was financial distress. So it was not one factor.
Chair's time has expired. The chair now recognizes the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Let me first go to Mr. Woodall. Is AIG designated as a SIFI, Mr. Woodall?
Yes.
Should it be?
Well, at the time when they were designated, we were coming right out of the financial crisis. And the first two designations were AIG and GECC, companies who had had some problems during the crisis.
Some problems? Big problems?
Big problems.
Okay, so it should be a SIFI designated.
At that time.
At this
It's about
time.
half the company now that it was
At this
then.
time? At this time, should it be a SIFI?
Right.
Well, let me just go on to Mr. Gruenberg on another matter. In the Dodd-Frank Act, Congress recognized that our banking regulators failed to appropriately engage in regulatory oversight of large banks leading up to the crisis. As such, we put in place enhanced prudential standards that set forth the basic requirements for a bank to be well-run, capital resolution plans, risk management, liquidity, among other factors. At the same time, the deliberative process in Congress led to an exemption from these requirements for banks below $50 billion in assets. Congress also directed the Fed to tailor certain regulations for large regional banks based on size, as well as provided the Fed with the option to exempt certain banks above $50 billion from certain requirements, both in committee and through potential riders to funding bills. Congress is now contemplating legislative proposals that would undo this important work. These proposals would instead rely on the Financial Stability Oversight Council to affirmatively designate banks for enhanced prudential standards for all but the very largest global megabanks. Chairman Gruenberg, do you think that such proposals would be ill-advised? What did the 2008 financial crisis teach us about how the failure of one or more large regional banks could harm our financial system? And in terms of bank resolution, which failure during the crisis era was the most costly for the FDIC's Deposit Insurance Fund?
Can you hit the microphone, please?
Yeah, to answer the specific question you raised at the end, the most costly failure to the FDIC during the crisis was the failure of IndyMac, which was a thrift institution with assets of about $30 billion that ultimately cost the Deposit Insurance Fund over $12 billion, which is the most significant loss during this crisis, and I believe in the history of the FDIC. And it does show the importance of having a prudential framework for larger institutions relating to capital and liquidity and other prudential standards. And to respond to the first part of your question, as a general matter, I think the framework in place is a reasonable one. It generally gives discretion to the agencies to tailor the prudential standards to the size and complexity of the institution, and I generally think that's an appropriate approach.
Well, let me just ask you this so it can be reiterated. Has the Federal Reserve already begun tailoring enhanced prudential standards for banks above $50 billion with increased stringency based on bank size? Would you just kind of continue on that?
Yes, Congresswoman, I believe, I wouldn't want to speak for the Fed, but just as an observer, I believe the Fed has done that, generally focused the enhanced prudential standards on the larger institutions above $250 billion, and has tailored standards for those below.
All right. Can more be done in this regard without reopening Dodd-Frank to potentially negative consequences?
Yeah, I do think as we progress in this process that this is a focus for all of the agencies to ensure our regulations are appropriate to the size and complexity of the institutions.
So basically what you're telling us, there's been no resistance to FSOC, taking a close look at what can be done and using its discretion to make sure that not only they honor Dodd-Frank, but they have the flexibility to make modifications where necessary.
I agree with that, Congresswoman.
Thank you, Mr. Chairman. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of our Capital Markets Subcommittee.
Thanks, Mr. Chairman. You know, I've been looking through the minutes, Mr. Chairman, if you can call them that, that the FSOC publishes. And one of the things I notice is to who actually shows up and who can attend FSOC meetings. It seems that some people, like Fed Governor Dan Petrullo, who is not a member of FSOC, is able to attend and attends various meetings of FSOC, while commissioners of the various boards and commissions do not attend. Seems that there's not very clear criteria as to who can and cannot attend. Back in September, according to minutes, the FSOC held with about 20 or so invited guests from various agencies. And again, yes, yet again, the commissioners of various agencies are not on those lists. So I'm going to take a page out of Al Green's methodology here and ask for a show of hands. All of you who are on the panel today who are part of a organization that has either a commission or a board, can you raise your hand so we know what you're talking, because not everybody up there has a commission or a board, right? Okay. So for those who have raised your hand, do you trust your commissioners or your board members as their ability to keep things confidential? So I'd say, do the members who just raised their hand trust their board members? Maybe I should flip it the other way. Is there any member here who does not trust their board members or their commissioners? They just can't keep things secret. Okay. So if that's the case, let me just run. Chair Massad, if any member of your commission wanted to come to you and ask to attend an FSOC meeting, you trust them. Can they come to an FSOC meeting?
Thank you, Congressman, for the question. I don't think that's the structure provided for in the law.
Would you personally object to them being there?
Well, I think it's important for the FSOC to follow the...
I don't know that there's anything in the FSOC rules that is there anything specifically in the requirements that say they cannot attend but other guests can attend?
I'd have to get back to you on that, Congressman.
Well, you've allowed 20 other guests to be in September, and I guess that was okay. Did you know at that time that they were allowed to be there or not? Let me go to Chair White then, since he doesn't know. Would you object if one of your commissioners wanted to attend an FSOC meeting personally? Would you have a problem with that?
I mean, I think the protocol is for the chairman to pick one person, typically staff person, to accompany them. That's the structure on it.
Right. I understand what the structure is. And I understand that you've been that the whole entire board has been precluding openness and transparency. What I'm trying to find out is for all of you who have just raised a hand who said you trust your board or your commission with secrecy, is there anyone that would say that they cannot attend? Well, good. Then can I have a commitment then of all those people who just said that they would not object, that you will work for the next meeting to allow your board and commissioners? Anyone here, please raise your hand if you will not encourage your chairman to allow them to attend the next board meeting. So let the record reflect two people. Mr. Grunberg, you will not recommend to the chairman that your commissioners be able to attend?
Correct.
I would follow.
Well, no, let me just go there. You didn't raise your hand. Do you not trust your members? Are they not able to keep things secret? I just want to be clear on that.
No,
Are you talking to me?
no, I certainly do, Congressman. Just a couple of points, if I might.
Sure.
From the FDIC, as it happens as a matter of statute, 3 of the members of our board are statutory members of the FSOC, so a majority of our board are represented, and I certainly have the greatest trust in our other directors. I would note that I share with our other directors all of the information available to the FSOC.
So, but you have no problem with Dan Trullo always attending quite frequently. So it is something about your board that you don't trust them, is what I'm taking from this.
No, sir.
So why do you object to them being there?
I think it's a matter of it's a matter for the entire FSOC. It's a matter of functionality in terms of the number of...
So in September, there was some
participants
20. That was not an issue of functionality, but for your own board members, I'm taking the perception here that either you don't trust your people or that you're doing something in secret. So which one is that, Mr. Grunberg? Or do you not trust your people, or you're trying to do something in secret?
Neither, Congressman, for what it's
Well, then you haven't given us an answer. Chair White,
trying.
will you recommend to the chairman, will the rest of you now, the rest of the panel who raised their hand, will you recommend to the chairman that these people, that meetings be open to the rest of the commission?
I'll follow the congressional structure. I think that's up
There's
to
nothing in the
Congress.
congressional structure. That's already been pointed. So will you make that recommendation?
I would discuss it with my fellow members of
Will you-
FSOC and the chairman. Discuss it with them as I have before. Discuss it.
So no one, will anyone here make that recommendation, positive recommendation? So let the chair reflect that no one who has come here before will make a recommendation they want to continue to keep their meetings secret.
Time of the gentleman has expired.
sorry.
The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Mr. Cordray, the CFPB's core mission is consumer protection, which may not seem linked to systemic risk. However, I don't think that is the case. Can you elaborate on what role consumer financial protection plays in the stability of our economy and how your agency's work helps inform FSOC?
Congresswoman, first of all, Congress set the structure of the council and determined which agencies should be represented there, and it's a broad cross-section of the federal financial regulators. In the case of the Consumer Bureau in particular, it's worthy of note that the financial crisis that gave rise to the council was caused, everybody agrees. People disagree somewhat as to the chain of events that led to this, but a meltdown in the housing and mortgage markets that transmitted through various channels through the economy and threatened the stability of the financial system, gravely threatened it. The very first issue that was raised at the first meeting, which was before I joined the FSOC, I was not yet the director of the Consumer Bureau, was mortgage servicing and foreclosures. And there were briefings on those at the first several meetings. Those are issues that are very central to the work that has been done in the early years by the Consumer Financial Protection Bureau. And all of us on the council are charged by law with examining the economic system for emerging threats to financial stability, which we do. The annual report has been a very good and transparent and thorough account of the council's thinking about both present and emerging threats, and is our best attempt to monitor and report on what we see in the financial system at that time. And there are various issues that each member of the council and each entity that they represent is more or less expert in, and we share that expertise with one another to try to arrive at a broader, more comprehensive view of the financial system than each of us could do alone.
Thank you. Mr. Gruenberg, we have heard from opponents of the CFI process that there is insufficient opportunity to engage with the council after designation. Do CFI designated firms have opportunities to meet with FSOC staff to review their status?
Yes, Congresswoman. As you know, as a statutory matter, the council is required to reevaluate a designation annually.
Thank you. Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Chairwoman Matz, you know, there's been a lot of discussion about what it means for a bank to be systemically important. And as you know, in February, the OFR, the Office of Financial Research, released a report where they examined the systemic risk indicators, and they used the indicators that had been developed by the Basel Committee. And they applied those to some of the largest banks and holding companies. And it was kind of interesting finding is that the report concluded that the least systemic U.S. GSIB was several times more systemically more systemic than the other major U.S. banks, the regional banks. Yet all of those institutions, you know, fall under requirement for enhanced prudential standards based on their asset size. And so are you familiar with that report? I'm sorry?
I have not seen that report.
You've not seen that report?
No.
Well, you know, one of the requirements is, or I guess main functions of OFR is to furnish, you know, the committee with information to hopefully help them make better determinations. And so I would hope that you would avail yourself of that report. But would you agree that setting up certain standards
to measure companies is appropriate? I mean, if you haven't seen the report, but basically they took the Basel standards, and they took 5 of them and applied those to those companies. Do you think that's a good way to approach that?
We've stayed away from creating bright lines and instead look at whether material distress at a company could pose a threat to the financial stability of the United States. And since each company has different business plans, different business models, we have not drawn a bright line. We're being very rigid about what the standard is. It's looking at the entire company and then making a determination based on very deliberate consideration.
Director Watt, have you seen the OFR report?
I have not seen the report you're referring to.
Well, since y'all haven't read the report, I guess I'll go to another line of questions. Section 113 of the Dodd-Frank requires FSOC voting members to consider at least 11 factors before designating a non-bank financial company for heightened federal supervision, including leverage, off-balance sheet exposures, scope, size, scale. Do you think that's, I'll start back with you, Chairwoman Matz. Do you think that's appropriate to use 11 different factors in the determination of whether a non-bank company is systemically important?
Yes.
Director Watt, would you agree with that?
Yes. I mean, we're not second-guessing the statute. We didn't write the statute, but I think all of them well, actually, I was involved in writing the statute, so, but I'm not in a position to second-guess it now. I voted for it, right.
Well, I think the point I'm trying to make here is that it's a little puzzling to me that it is appropriate for non-bank entities to be subject to standards. And I think, in fact, Director Watts, you said in your testimony, that you're committed to an analytical process. And so I think the interesting thing is we subject these non-bank SIFIs to 11 different factors, yet we only subject banks to one factor, and that is size. And so shouldn't we be applying, if this is going to be an analytical process, shouldn't we establish factors for analyzing banks in a way of analyzing whether they're systemically risky or not?
I think these are really the same factors that any of us would take into account. They may not be specified in a statute for individual banks, but one of the primary problems during the meltdown was that there was no supervision and no method to get at non-bank entities because they didn't have, they weren't answerable to anybody.
Well, I'm not talking about non-banks. I mean, we've talked about what we do.
I thought that's what this was designed, that's specifically what this talks about.
I guess the question is we're subjecting banks to, based on their size, we don't even consider the other factors. And so shouldn't we be considering a litany of factors before we determine whether these banks should be subject to enhanced prudential standards?
I think probably it'd be more appropriate for Mr. Cordray, Mr. Curry, and Mr. Grunberg to answer that. I don't regulate banks, but I would think that they take into account all of these considerations.
But you do sit on FSOC, isn't that correct?
Time of the gentleman has expired. Chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you, Chairman Hensarling and Ranking Member Waters, for holding this important hearing. I also wish to thank our distinguished panelists for testifying today and for their dedication to ensuring the safety and soundness of our financial system through their participation on the Financial Stability Oversight Council. As a senior member of this committee, I applaud the Council's progress to date, and I look forward to hearing from our panelists on the Council's priorities moving forward. Two particularly important lessons learned from the crisis come to mind today. First, it's absolutely essential to have a bird's-eye view of our financial system in order to identify and prevent systemic risk from destabilizing our entire economy. In crafting the Dodd-Frank Act, we in Congress recognized this fact and created the Financial Oversight Stability Council, an entity comprised of our banking, insurance market, and housing regulators, and tasked with ensuring the financial stability of the system as a whole. Secondly, we should not just assume that the markets will take care of themselves. Instead, we must support and empower our regulators to be able to act when needed. We should be looking to strengthen our financial system and the safeguards we incorporated after the lessons learned from that last crisis, rather than berating our regulators and attempting to restrict their ability to act by tying them up in bureaucratic knots. My first question goes to Mary Jo White. A much criticized report from the Office of Financial Research, OFR, discussed the risk that the asset management industry posed to the United States financial system. The critics have argued that the asset management industry poses absolutely no risk to our financial system. However, haven't the Council's actions, including the publication of the report by the OFR, spurred the SEC to take action with respect to money market funds?
The answer is the SEC independently proceeded. I mean, I'm aware of, obviously, the preliminary recommendation of the FSOC, but the SEC proceeded independently to reform the structure in some ways of money market funds.
Can you elaborate on what SEC actions were spurred by the FSOC and how these actions are making our markets and investors safer?
Well, again, I think the SEC proceeded independently of the FSOC recommendation, been studying it for some time, and certainly since I've been there as chair, proceeded totally independently. It was an important thing to do, I think. I think, to allude back to your first comment, though, I think it's very important that that bird's eye view, that big picture view be provided by, all of the financial regulators who do sit on FSOC.
Thank you. Next question to the Comptroller of the Currency, Mr. Thomas Curry. Some have criticized Dodd-Frank's FSOC structure for allowing some of your agencies to have voting rights on non-bank systemically important financial institution designations made by the FSOC. Are you comfortable with the deliberative materials you receive from the Council staff, and do these materials adequately prepare you to make informed decisions?
Thank you, Congressman. There's an extensive amount of material that is presented to me as a member of the FSOC in connection with any designation. And there's actually a fairly elaborate process, 3 stages, by which that information is developed. Stage 1 is from publicly available information or from contacts with potentially with supervisors. Stage 2, which gives notice to and engages a institution under consideration, the opportunity to engage with the Council staff and our designation committee. And then finally, we have a process, Stage 3, where there's extensive communication and development of analysis and records for the Council's consideration.
Thank you. Mr. Cordray, when assessing systemic risk for our financial system, has the FSOC taken a look at aggregate debt levels from various areas of the economy?
We have and believe we should.
Do you think the current amount of debt in the aggregate poses a risk to our economy, and why or why not?
I think everybody could have their own personal point of view on that. I think this is certainly one of the factors that the FSOC has looked at in terms of thinking about systemic risk, is both debt and leveraging of levels of investment, and therefore how much risk could be transmitted through the system if there were adverse developments to the extent to which capital is deployed. And so I do think that's an appropriate factor in looking at the kind of issues raised before the Council.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. We've put up a chart. I don't know if everybody can see it or not. I know we can see it pretty well in the back. It's on the side. I'm not sure we can get there. But I'd like to follow up on the chairman's comments and questions a while ago with regards to non-bank designations. And what I'm concerned about is perhaps Fed-driven decisions on some of these designations. And if you look at the bottom part of the chart there, you can see that the National Credit Union Administration in 12 and 13 had 2 members that they dedicated or had done some analysis with regards to non-bank designations, and in 14 we had none. Ms. Matz, you an expert on insurance analysis? Okay,
No.
so we have, you're not an expert, and we have no one at your agency that is designated to do analysis. This information, can't read the fine print there, you can in the back of the room. This analysis, by the way, comes from data that's given by your agency to the GAO, if I'm not mistaken, which is in this report right
I
here.
don't think that's correct, though.
Sorry, Ms. Matz, that's the information you gave to the GAO and requested. And so my concern is the Federal Reserve has 25 people designated to make this analysis. You have 0. And yet you're making it.
That's not correct.
That's not correct.
It's been steady. I don't know where they got that information from, but
They got it from you.
it has not from me personally. It has
That's
not
written right
changed.
there on the bottom of the sheet. It says that each agency, the information came from each member agency and represents individuals involved in the analytical work. So
It's not correct. We still have 2
how many do
people.
you have then?
We have 2 people.
2 people. Okay, are they experts in insurance?
They are not experts in insurance.
They're not experts in insurance. So how can we make an educated analysis whenever you're making designations with regards to non-bank designations which involve insurance companies? How do you make that determination then?
It's not the insurance part of the business that results in the designation. It's in the financial services part of the business and how intertwined it is.
So the insurance part of the business is not important with regards to the designation of a SIFI?
No. It's not. It's the financial services part of the business that
The
we
financial
consider.
services part of the business is the
Right.
only part that you look at?
Yes.
Wow. Okay, Mr. Cordray, you sort of struck out all across the board there as well. Are you an insurance expert, sir?
I'm not an insurance expert.
Is this number incorrect, as Ms. Matz indicated hers was?
I'm not exactly sure what analysis was used to get to that number, but the reality is that each of us has deputies who work together on the FSOC on the analysis. Then I am briefed on the analysis and have a chance to review the materials, extensive materials submitted by companies.
You're saying this number is incorrect as well, even though this is information your agency gave the GAO?
I'm saying that the slice on it here, I think, is not reflective of the full work done at the FSOC. Nonetheless, I'm not an insurance expert, but other members of the council are not banking experts. Certain members of the council are not investment experts. It's all of us together who
Mr.
do
Cordray,
this work together.
this goes to the heart of the matter here. You're sitting on a board that makes the decision on the designation of whether something is systemically important or not. And if you don't have the personal expertise, you need to have somebody on your staff, because otherwise it's not an independent vote that you're casting. It's a vote based on what the Federal Reserve or some other member of this board is telling you the way it should be done. And that's not the way the system should work.
I don't think that's correct. First, there's FSOC staff. There's staff of the member agencies contributed who work together. And then there's our own analysis. But again, to focus only on the insurance company potential designations is only a partial picture.
Okay.
There are bank designations, there are other financial company designations, there are investor area designations. Everybody has relative expertise in some areas, less in others.
I'm running out of time here. Mr. Masad, you have 0 people all the way across the board. Is that incorrect as well?
I think your chart runs through July of 2014.
Right.
I took office in June.
Okay.
Shortly after that,
Okay.
I had my staff involved in the designation that was.
So now you
named.
do have some people involved in this designation process.
A few of
Many?
our staff. Yes,
1,
sir.
2, 10?
Well, it depends on the issue, sir. We're a small agency. We're very limited in our resources. No one is fully dedicated to these issues, but certainly I try to get people involved as necessary.
Okay, one more quick comment before
Sure.
I run out of time here. With regards to the SEC, Ms. White, Your numbers are 0, 2, and now 12. And in your testimony, you indicate, or you say that it's important that it be data-driven and conduct rigorous analysis throughout the process. How can you do rigorous analysis back in 13 when you made the designation approved with 2 people, and now you have 12? Was that a stumble back then, and you realized you didn't have adequate staff, or what was the problem back then?
I can only speak to the time since I've been there, which is
You were there at the
April
time this was done.
But I didn't participate in the PRU designation. I'm not, I'd have to drill down a little bit on those figures, but what we do at the SEC, I think my written testimony reflects this, is that, and again, it's not full-time people devoted to FSOC work streams, but who we need in the particular areas are called upon to assist me in analyzing the information.
The concern is still there, that we're not doing our job of doing analysis and letting the Fed do it.
Time of the gentleman has expired. The chair now recognizes another gentleman from Missouri, Mr. Clay, ranking member of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank all the witnesses for attending today. Some have criticized the FSOC's designation process as being opaque. The GAO also made several recommendations to the FSOC to improve its transparency. To your knowledge, how has the FSOC addressed the recommendations of the GAO? Would you also describe how the FSOC changed its process with the February 2015 supplemental procedures announcement? And I mean, anyone can volunteer on the panel. It's so many to choose from. Ms. White, maybe?
I think in terms of the GAO-specific recommendations, I think those were responded to by the Secretary of Treasury as the chairman of FSOC, not agreeing or disagreeing with the recommendations, but I do think that what I'll call the process and transparency changes made by FSOC in 2015 address a number of those in terms of both transparency, clearer information to companies as to when they can interact, when they are being analyzed in stage 2. There was a lot of back and forth before those changes, but I think a number of those changes are responsive to those recommendations.
Can you, yes, sir, go ahead.
Just to respond to your question, Congressman, I think the focus of the February procedures was to try to enhance engagement and transparency for the stage 2 process. So it provided notice to the firm that it had been advanced from stage 1 to stage 2, an opportunity for the firm to engage with the FSOC staff. If requested, the public information that the FSOC was using as part of that stage 2 review, as well as notice if a firm is not advanced from stage 2 to stage 3, and if a firm is advanced from stage 2 to stage 3, it would be notified of that, and then a set of procedures for engagement with stage 3. So it was an effort to provide both greater insight for the firm in terms of notice and greater opportunity to engage with the FSOC.
Could I simply add, to me, this exemplifies vigorous congressional oversight. The Congress and this committee have had comments on transparency at the FSOC. We've listened to those. The GAO did a report with comments. We've listened to those. It's a new body. It's still just a few years old. Transparency is developing and evolving as we go, and I believe has been responsive to a lot of the concerns raised here.
Thank you. And what changes have you made to the annual and 5-year designation review processes to ensure more due process rights are available to companies? Mr. Greenberg, can you?
Yeah, I think the procedures make clear that as part of the annual evaluation process, a company can submit information, engage with the staff in terms of the information being presented, and get feedback in regard to the process. And the procedures provide a assurance of a hearing with the FSOC at least every 5 years.
General Electric has announced that it would shed most of its financial assets which operated out of GE Capital. In making the announcement, GE noted that the company will work closely with its regulators and staff of FSOC to take the actions necessary to designate GE Capital as a systemically important financial institution. Further, GE CEO noted, "We have a constructive relationship with our regulators and will continue to work with them as we go through this process." Can you describe how FSOC will go about working with GE? And anyone? Yes, sir.
There's an ongoing dialogue with the company as to what its plans are, what its strategic or structural changes are, and that will continue. At an annual review or sooner, a decision will be made once those plans have been actually executed.
I see. Thank you very much. And, Mr. Chair, I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Monetary Policy and Trade Subcommittee.
He's not.
Thank you, Mr. Chairman. I apologize. I had to step out. I've had some visiting constituents and wanted to kind of make sure that I understood where my fellow sub-chair was headed. And I think we're kind of on the same path and direction. I do want to, at some point, Mr. Woodall, get back to your written testimony, which I found very fascinating, and have a couple of questions there. But I would like to also see a show of hands. Who here believes that Congress has the right to understand how FSOC makes its determination decisions? So if you believe that Congress has the ability, should have it. So okay, record reflect that all believe that that is an important part. Well, I'd like to get a sense of what materials FSOC members reviewed before making final determinations, and are there memoranda, other materials prepared by FSOC staff that you rely on to make your decisions? Who here is willing to share that? If you'd give me a show of hands, if you'd raise your hand, who's willing to share that with us? Nobody? Okay. Let me repeat the first question, I guess.
Congressman, can I make a comment?
Sure, Mr. Mossad.
I think Congress is entitled generally to whatever information it wants. I would simply want to check with staff and particularly to make sure we're abiding by our obligations to keep non-public information confidential. But certainly Congress is entitled to get what information it wants.
Okay, I mean, and maybe that's not even public meeting. Maybe that's a private meeting being able to share that. So, Mr. Grunberg?
Congressman, I think the analogy here is to one of our regulatory agencies considering action in regard to a particular institution. That's really what the FSOC is doing in regard to. And so 2 points. One, if we're dealing with confidential supervisory information, which would probably be an applicable standard here in the FSOC, that's generally not shared, although upon congressional request, as we have in other instances, at the end of the day, Congress gets the information it requests. So
that sometimes takes a little longer
I understand,
than the time frame you may have noticed around
I think that would sort of be the...
So you believe that Congress has the right to review FSOC's deliberative materials?
I think Congress has the right to request any...
Those are two very different things.
Yeah,
okay.
No, but I think that if you accept the premise we're dealing with confidential supervisory...
Sure. And if we can do that, and whether there are certain things that... What I don't want is redacted sheets that, look like, they're blacked out all the way. What I'm looking for is a venue then for us to be able to review, to understand. Because frankly, I think if you hear a lot of questioning on both sides of the aisle, we simply do not understand. Mr. Woodall?
I was just going to mention, I think that there's one confidential memorandum that has been made public. The confidential basis in the Metropolitan Life case, it's my understanding, has been filed in the court and is a public record.
Okay. Mr. Watt.
I would just want to be clear that the reason I would not raise my hand because I would not make a unilateral decision. This is a collaborative body. And FSOC, if we got together, would turn over whatever would appropriately be turned over to Congress. And I think I would be supportive of that being a robust turnover of information, but I certainly wouldn't make a unilateral decision.
You've sat on this side of the microphone and know that sometimes it takes far too long to get responses.
But that's not a justification for an individual member of a collaborative body
No, fully
to make
understand.
a unilateral decision
Fully
to
understand.
turn
So
over
I'd love to have, but
confidential
you all
information.
just raised your hand, and since you are the voting members, you all just said we've got a right to this. So let's come up with a collaborative way of finding out how we're going to do that. Mr. Woodall, real quickly, I was fascinated in your written testimony about how you have been prevented from, quote, being in the room with international insurance policymakers. A number of us did a trip to Switzerland back about 2 months ago. They seemed genuinely surprised that Congress was not up to speed on exactly what Team USA is saying and doing in that room. And also, I would, as we were indicating, many of us, both sides of the aisle again that were on this trip, support of your involvement in that. They seem genuinely perplexed that someone with insurance expertise was not being allowed to be a part of that process. So real quickly, if you comment.
Well, you know, in international things, you work by consensus, as you've been told. The consensus within the Team USA, you've got 3 U.S. people representatives at the IAIS, which is...
And you've said that you've been supported by 2 of those
Right.
for being in the room. The third one that is not supportive is?
It's Treasury's
Treasury.
FIO. Without that consensus, and they're taking the position, and I want to be fair about this, they're taking the position that the statute gives me no such authority, that I have no duties or responsibilities designated in the statute at all.
The time of the gentleman has expired.
I look forward to remedying that.
Chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
I thank the chairman and ranking member for calling this important hearing. And actually, this is the most people I have ever seen at that desk at any hearing or reviewed in history at a hearing. And it's a very important topic. I'm glad to see my former colleague, Mel Watt. Welcome back. My question is, when the FSOC is analyzing whether a company is systemically important, it doesn't measure whether the failure of the company would destabilize the system in normal times. Instead, it measures whether the company would destabilize the system in a period of stress in the financial industry. And I have 2 questions for the panel related to this. First, why did the FSOC choose that standard? It seems that this standard could certainly play a key role in determining whether or not a company is systemically important. And secondly, what historical precedents does the FSOC review in making these evaluations in a period of stress in the financial community? Do you look at the 2008 financial crisis, the Asian financial crisis of 1997 and 98? What do you look at as precedent when you study these crises? And I'd like to start with Chairman Grunberg and then SEC Chair White and Controller Curry, and the thoughts from the panel on these 2 questions. Thank you.
Thank you, Congresswoman. I think the view was that would the impact the failure of the firm would have in a stressed environment would be the most realistic scenario to try to assess the systemic consequence of the firm. And I think it was very much a product, certainly, of the 2008 crisis experience. And I think we looked to the experience in other crises in trying to make these assessments. But I think that was the threshold judgment.
Mm-hmm. Yes, if I could pick up there, I agree with that analysis. The Council, in its guidance, announced how it would be approaching that. It would be analyzing in a period of stress, which would only, I think, make sense given what your purpose was in terms of judging and trying to prevent significant negative impacts on the financial system. Things work in times of non-stress, don't work so well in times of stress. In terms of what is looked to, not limited certainly to how things operated in the 2008 period, but certainly that is typically part of the analysis, but you look to other scenarios, stress scenarios as well.
Curry,
Yes,
and then Watt.
Congresswoman Maloney. I think I agree with my colleagues. I think in order to assess especially the interconnected aspects of the financial system, you have to assume in the first place that it is in a period of stress. I also think there's some textual support within the statutory standard to take that approach. And in terms of what we would look to for the range of historical experience, I think the 2008 crisis certainly stands out in terms of its significance, its breadth, and what I think people would have never assumed would be the underlying source of it, or this spark, the housing crisis. And I think that would be our approach.
Okay. Mel?
I was just going to refer you to the specific wording of the statute, which says that the council determines that material financial distress at the non-bank financial company, that's the standard that is set up in the statute. So it's an appropriate standard, I think, but again, we're not trying to second-guess the statutory provision that was written by Congress. We're following the statute, not second-guessing it.
Well, I'd like to ask Chair White, as you know, there's been a great deal of discussion this year about how the FSOC could improve its SIFI designation, and one of the suggestions that I kept hearing, and probably you heard also, was that the FSOC should tell companies what actions they needed to take in order to avoid being designated as a SIFI. And this sort of struck me as a dubious idea, because do we really want the FSOC to be making these kinds of core business decisions for private companies? In my opinion, the FSOC should identify the systemic risk, and then the company should figure out the best way to restructure its business to eliminate the risk. And when the council adopted changes to the designation process in February, you decided not to include this suggestion. Can you elaborate on why the council wanted to maintain this distinction, and do you think it's important for the FSOC not to use the designation process as a way to tell companies how they should be run?
Well, speaking for myself, I largely agree with your assessment. I don't think FSOC should be telling companies how to structure their business. I do think, maximum transparency, as we've been discussing earlier, is obviously something that we care about at FSOC and is important to do. But very often, also, most often, I think the designations are not going to be based on one or two or three metrics, but rather a business model. So it's a very complex undertaking as well, but I don't think FSOC ought to be telling companies how to run or structure their business.
My time has expired. Thank you very much.
Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chairman of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. Just to reiterate, I believe when Chairman Henschling asked the panel who had insurance experience, if I recall, it was Mr. Woodall and Chair White. Is that correct? And so if I'm to ask the panel, if you were to point out the one insurance expert of all the witnesses today, who would you point to? You got probably two choices.
Mr. Woodall.
Thank you. I would probably agree with you, Chair White. Mr. Woodall.
I want to overstate my expertise here. Okay.
Does it concern the panel that the one person with insurance expertise is the one individual who dissented in the designation of Prudential and MetLife? Or as Chair Matz, as you say, that really doesn't matter because we're not looking at the insurance side, we're looking at the financial service side.
I think that's correct, and also it should be noted that the head of the Federal Insurance Office did support the designation and also has considerable experience in the insurance industry.
Do they vote on FSOC?
No.
No, that's right. So Mr. Woodall, who does vote, was the one dissenter.
That's correct.
Who was the one with insurance expertise, which is concerning. Does the panel, I think the panel has all agreed on the oversight front that Congress is entitled to do oversight over FSOC. Is that correct? You all agree with that. Our committee, under the signature of the chairman and every single subcommittee chairman, sent a letter to Jack Lew asking for 13 different points of information from FSOC. There were partial compliance with a couple of those. Does the panel disagree that if we've already gone through a designation process, that Congress is not entitled to non-public information? You guys don't disagree with that, do you? Why aren't we getting this information? Why aren't FSOC members complying with our request? It's concerning for our panel. If you're concerned about the questions that you get today about the transparency of FSOC, it's because the elected members of this body don't have timely compliance or any compliance from Mr. Liu or any of you. Would you guys always, if there's already been a designation, if we're asking questions about AIG, Prudential, or GE, you can make the argument that with MetLife there's litigation, so we don't want to give you that. You might say that, I won't agree with that, but fair enough. AIG, Prudential, and GE, will you comply with our requests about the analysis that went into the designation process? The memos, the correspondence, all that information? Everyone here, will you comply with that request? Raise your hand if you'll comply with the request to provide us that documentation. I got no takers. So, why not? Mr. Gruenberg, why not?
Congressman, if I may say, you raise a fair question. I think I'd probably want to go back and look at the request. It seems to me the line here is when you're dealing with confidential supervisory information, and we're dealing with the three companies you referenced. They are open institutions, so you'd have to strike a balance there. But look,
Chairman Gruenberg,
I take your point.
Listen, do you know that there was a recent attack, some alleged by ISIS, in San Bernardino?
Yes,
You're aware of that, correct? Do you know that this body gets intelligence briefings from the FBI in regard to ISIS and terrorist attacks? Now, I would argue that American lives are in danger by these radical extremists. Does anyone argue on this panel that anyone's life is in danger by the work that you do on FSOC?
No.
Raise your hand. Is anyone's life in danger? And so we can get FBI briefings, but you won't give us briefings on the analysis that's gone into designation of certain companies in America? Mr. Mossad, will you explain that to me? Why am I entitled to briefings on ISIS and not from FSOC designation?
Well, sir, I could only speak to the FSOC issues. I'm not familiar with the intelligence side. But I would say that as a general matter, I think certainly transparency and accountability is important.
No. Explain why I get ISIS FBI briefings and you can't send me information on designation.
I do think there are issues that we have to think about in terms of the non-public nature of certain information.
No. The FBI sends me non-public information as well.
I respect that, sir.
Are you making decisions that affect someone's life?
No.
No. Is ISIS affecting people's lives?
Yes.
Yes. I would think that's far more serious, and the information that we're entrusted with is far more serious than the information that you have and aren't complying with. One quick question. The Bank of England sent a letter to FSOC asking questions about why Berkshire Hathaway is not being considered as a SIFI. Some have argued they have political clout in this town. I think Barack Obama said he's a great friend. Is there a political analysis and connectivity with people in power that go into the determination of designation on FSOC? Quick answer, maybe, Mr. Chairman? Mr.
Not
Watt?
from me.
Anyone?
No.
No. I yield back.
Chair now recognizes the gentleman from California, Mr. Sherman.
Thank you. Folks, I do think that your decisions are life and death. You'll never meet the people. But we have another 2008. Every one of our districts will have higher divorce rates, higher unemployment rates, higher drug use rates, and we will never be able to go to a particular funeral the way you can in San Bernardino and say, this is what happened. But there are thousands of Americans who would be alive today if we didn't have the 2008 meltdown. So your work is every bit as important as those who are focused on terrorism. The Ms. White, we've got the Financial Stability Board. We don't have, well, we have one of its members here, but it doesn't answer to the American people. How can we be sure that they don't push us to an activities-based approach on asset managers or anything else, that the decisions that are made that affect the American people will reflect the decisions made by those answerable to the U.S. government? and that it won't be just a matter of, well, we went to the meeting, everybody else kind of wanted to go in this direction. I've seen this people talk about terrorism. We made loans from the World Bank to IMF, and I was told, oh, we'd never let that happen, it's all consensus. And then they came back and said, oh, sorry, we got outvoted. So how do I know that to get along, we're not going to go along with policies that don't reflect U.S. decision-making?
Well, I think, and as you point out, the Treasury and the Fed and the SEC actually sit on the steering committee of the FSB and have since, I think, 2009, when it was established, very importantly, to look over potential risks to financial stability globally. But whatever comes out of the FSB in terms of recommendations or suggested standards is not binding on the U.S., and certainly with respect to where there's overlap, for example, in the designations that have been talked so much about. We act independently of the FSB. There's separate processes.
Thank you. There's all this focus on whether an entity has a lot of assets. Lehman Brothers didn't go under because it had too many assets. It went under because it had too many liabilities and contingent liabilities. Ms. White, when you analyze whether an entity should be designated as SIFI, do you look at the size of their assets, the size of their balance sheet liabilities, or the size of their off-balance sheet contingent liabilities, including credit default swaps?
All of the above, and then a host of other factors too, so that you can...
I would hope that you would focus on liabilities rather than assets. No one ever went under because they had too many assets. But in looking at contingent liabilities, Mr. Woodall, I hope that we would not count those liabilities of contingent liabilities of regulated insurance companies, because the state regulation of insurance companies seems to have weathered the storm. Would we designate a company as a SIFI just because they had a lot of assets and liabilities if all those assets and liabilities we were looking on were part of a state-regulated insurance companies where the state regulators had determined that they had adequate reserves?
Yes, Congressman, one of the factors is the regulatory scrutiny that the company goes through. Mm-hmm. And obviously, we do have to look at not only assets and liability, but the matching of the asset and liabilities. And in insurance companies, those liabilities are long-term liabilities. They're not like liabilities of a bank that could disappear if everyone came in and withdrew their account.
Dodd-Frank calls for annual review of designations. Do you have a way for a company, do we have a good process to allow companies to be de-designated, particularly if they've reduced their risk profile? Ms. White?
I think there is a good process. You always want to keep looking at possibly enhancing it, but essentially, at least annually, the council has to look at that. We've also made clear that the companies can engage with the staff on those issues, and then every 5 years, under some of the new procedures, they're entitled to a full hearing.
I hope that you'd refine that process further. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman. And since we have this distinguished group together, I'd like to visit about my concerns with the Basel III leverage ratio rule as it is applied to certain derivative clearing services and the impact it will have on the ability of my constituents to hedge risk. So first, I would turn, of course, to our derivatives market regulators, Mr. Massad and Chair White. When market participants utilize derivatives to manage their risk through futures, options, cleared swaps, they must find a member of the derivatives clearinghouse willing to guarantee their transaction with the clearinghouse. How does the margin that a market participant posts to a clearing member affect the clearing member's ultimate guarantee exposure to the clearinghouse?
Thank you for the question, Congressman. I do believe it does reduce that exposure. Let me say generally on this issue that I support strong bank capital requirements, and I support the SLR generally. And the issue I've raised is really a very narrow one. I don't believe we should be excluding derivatives from the SLR, but I do believe it's important to make sure we're measuring the exposure accurately, and I do believe that the margin that is held by the CCP, in other words, margin collected but then actually transferred to the CCP, that we should think about that in terms of how we recognize the exposure.
Chair White?
And I would just add that I think you should always be judging the, the impacts such as you describe, frankly, in a variety of contexts, in a variety of different, rule contexts as well.
And I'd now turn to our banking regulator friends, Comptroller Kurtzy and Chairman Grunberg. In many instances, these clearinghouse members are banks subject to Basel capital requirements, which require them to hold capital against the guarantee they provide on the behalf of their clients. We can all agree that banks have exposure in the event their clients are unable to fulfill the obligations, and banks should hold capital against that exposure. But shouldn't that measure of exposure accurately reflect the client's margin, offsets the bank's exposure to the clearinghouse?
Congressman, I think the number one protection in the clearinghouse context is really that the member bank be strongly capitalized and to be able to perform in adverse circumstances. So having strong capital ratios really is a fundamental part of our regulatory structure and the safety and soundness of the system, including the clearing of swaps. Just by definition, I just want to point out a leverage ratio is not, by definition, a risk-based measure. So by definitionally, it would be inconsistent to import measures of exposure or risk as a general matter.
Congressman, I agree with Comptroller Curry. I think the core issue here is, the margin is posted with the CCP, but in addition, the CCP is asking the intermediary bank for a guarantee. And the potential loss from the derivative exposure could substantially exceed the margin that's posted with the CCP. That's why, the guarantee is imposed, and the capital is really designed to protect the bank against the downside risk from that derivative exposure.
I would just simply note to my friends, if we create a system that we require such capital requirements above and beyond what would appear to be necessary, we will cause financial institutions to not participate. And the next time we have a Lehman Brothers or an FM Global and a major failure and their clients need quickly to find a new clearing member, a new place to cover their outstanding positions, their margin, there may not be any sources. Having been a member of this committee through the wonders of 2008, when the worst case scenario occurs, you have to be totally prepared. I'm just concerned with Boswell, we're headed in a direction that will limit my constituents' options, thereby increasing their cost and reduce these risk mitigating tools. So I just simply note that to all of you and ask that you bear that in mind. We're undergoing pressure back home now in Oklahoma in both the ag and energy sector. It's real pressure. It's something that will take time to overcome, but these tools have been, continue to be important. So let's not allow Boswell to cause unintended damage. With that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. Chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. I want to thank the witnesses for your willingness to help the committee with its work today. I have a question for Chairman Grunberg. A number of the members on this committee have been working with Vice Chair Tom Honig on a proposal that would give some regulatory relief to some of our small banks. Now, we're looking at banks, community banks that are in the traditional business of banking, taking deposits, making loans to businesses and individuals. And the way this would work, we have not accepted all of Vice Chairman Honig's recommendations, but we have focused on a number of them, which would be to be eligible for regulatory relief, the financial institution must hold no trading assets, no derivative positions other than interest rate or foreign exchange, have a limited notional value of all the bank's derivative exposures otherwise, and maintain a ratio of gap equity to assets of about 10%, no less than 10%, I'm sorry. And in return for that, we would give, under this legislation, we would give relief in this form. Those banks would be, the compliant banks would be exempt from Basel risk-based capital standards. The stress tests, in some cases they would be exempt. In other cases, the stress tests would be every 18 months instead of every year. So we're trying to reduce the cost there for compliance. And also exemptions from submitting call reports and schedules. Now, this actually goes back to Mr. Sherman's question before, where we're actually regulating activity, not necessarily size. So if a bank's not engaged in risky activity, we think, and they're doing the right thing, we think they ought to be entitled to relief. And this has been a very high-cost issue for smaller banks. I just wanted to get your sense on whether this is something that you would be receptive to.
Congressman, I am sympathetic to the concept, the core concept being that if a smaller institution is very strongly capitalized on the leverage ratio, that's the 10% that you referenced, and doesn't engage in higher risk activities, it would be eligible to reduce or compliance with the risk-based capital standards. I think that core concept really makes some sense. And I think that's certainly an issue for the Congress to consider, and I think as part of our regulatory review process, within the framework of our capital rules, that may be something we might be able to consider on a regulatory basis.
Okay, I do want to fixate on that word sympathy, because I think a lot of our small banks,
I understand.
they're good with the sympathy. You know, they're looking for actual relief now.
Let me say I'm open to pursuing that approach, Congressman.
All right, Mr. Cordray, you got any worries about that? Have you thought about that proposal? I don't want to. You might be out of pocket on this issue. I'm not sure.
No, we have, and if you look at our mortgage rules, we tiered the application of those rules. On the qualified mortgage, what we call the ability to repay rule, we made special provisions for smaller creditors, and in fact, they have increased their share of the mortgage market, credit unions and community banks. And frankly, it's appropriate, because if you look through the financial crisis, the default rates on loans that were issued by smaller creditors, particularly depository institutions, had a much better, that is, lower rate of default than other mortgages made generally in the marketplace. So where we can take that into account and think about how we can apply different provisions for different levels of risk, I think that is entirely appropriate, and we will continue to do so.
And I do want to, you hit right on a point that I didn't mention, which is that in those cases where a bank is willing to keep that mortgage in their portfolio, it would be deemed a qualifying mortgage. So because you're not issuing to sell it, you know.
We're comfortable with that, particularly for smaller entities, but there were larger entities before the crisis that kept mortgages on their balance sheet and blew up the system, Washington Mutual, Countrywide, and others. So at smaller levels, I'm quite comfortable with that.
All right, fair enough. Thank you, Mr. Chairman. I'll yield back. Thank you.
Gentleman yields back. The chair now recognizes the gentleman from California, Mr. Royce, chairman of the House Foreign Affairs Committee.
Thank you very much, Mr. Chairman. I had a question.
I don't think your microphone's on.
Thank you, Chairman. Last month, in a hearing before the committee about due process issues with FSOC, Professor Jonathan Macy of Yale Law School stated that with respect to the actions that the FSOC have already taken, there is a significant danger of increasing rather than decreasing systemic risk. And his point, as he explained, was that this was because the FSOC is ignoring certain risk mitigation strategies and herding entities into particular risk strategies, which decreases diversification and then increases the systemic risk. This could also happen indirectly, with companies making choices to merge, sharing in the costs of compliance, and creating greater economies of scale. We've seen this in the banking sector, or more directly with the implied or explicit backing of the government, as in the case with the GSEs. So I was going to ask Mr. Curry, Do you view the potential for regulators to create systemic risk as a problem? And what actions have you taken to make sure that, and I'll also ask this of Chair Matz, that the FSOC's designations and enhanced prudential standards of the Fed are not increasing systemic risk per the thesis that the Yale professor puts forward?
Congressman, the FSOC actually is looking at, and this is referenced in our annual report, looking at some of the consequences of changes within the marketplace, including regulatory changes. There are behaviors that have changed. Institutions have either left or entered different types of business, not the impact of non-banks. Those are all things that we've identified as emerging or potential emerging risks that require further monitoring and, if necessary, potential action down the road.
And Chair Matz, if you could just weigh in there.
Thank you. More specifically, as the designation is being considered, the company has an opportunity to present any evidence to the staff, whether in person or in writing. And so if they think that there might be information that would be helpful in making the, in determining whether to designate, they have every opportunity to make that information available to us.
And lastly, I'll just ask Chair White, do you agree that this is a problem? Would you like to weigh in on your
Well, I think it's
perception on it?
certainly something that I think we need to be constantly keeping in mind with all of our regulations, what impacts they're having, what mitigators we ought to be considering in addition.
Okay. Now, I'm trying to better understand how the interaction on another subject here between the Office of Financial Research and FSOC members works. After criticism by this committee and the public on an OFR report regarding the asset management industry, the FSOC sought public views on the industry and later issued a request for notice and comment on asset management products and activities. Separately, the SEC put out the OFR report for public comment. Can I ask the panel, do any of you see a reason why all OFR public reports should not be open to public notice and comment? Does anyone take exception to that concept? For the record, Mr. Chairman, I'd like to say that the witnesses, for the record, saw no reason to continue the practice of OFR not allowing for public comment on their reports. That's the point I wanted to make. I think it's important that they do so. And if I have time here, the FSOC has not designated any asset managers as SIFIs, which is a step I support, as these firms operate with little leverage, if any, and the risks they manage are borne by those whose funds they invest. But the FSOC is now apparently considering the industry under activities-based regulation, the second prong of Section 113 of the Dodd-Frank Act, rather than material financial distress, the first prong. My question is not about asset managers, but rather how FSOC came to this decision and why a similar process wasn't used when designating insurance companies. Mr. Woodall, is it fair for the FSOC to offer different amounts of process to different industries, and why not take the same amount of time and get it right?
Well, Congressman, I think that we've already discussed the fact that in activities, which has been my main goal in the insurance company, it's evolving now in the council. The council is young, it's evolving, and I welcome the idea of taking a pause and getting into looking at the activities across the segment. And I hope that they will do that for the insurance industry too.
Thank you, Mr. Chairman. Thank you, Mr. Woodall.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you very much, Mr. Chairman. Panel, I'm very concerned about the Department of Labor's fiduciary rule. Let me explain why. I've spent most of my adult life working hard in the area of wealth building in the African American community. And our president is a wonderful person. He is a decent, good man. But as an African American, I'm not sure that he has been properly advised as to how devastating this Department of Labor ruling will be on the African American families in terms of wealth building. Now, I say that as one who, I'm a graduate of the Wharton School of Finance where I got my MBA. I went off and much of my work has been in investment. I had an investment portfolio in my own business that I started. As a result of that, they put me on the board of directors, executive board of directors of the Wharton School. And there, in that position, we pulled together, along with John Scully, who was the chairman of our board and chairman of Pepsi-Cola at the time, an extraordinary program of wealth building. But what we found out was there were 3 elemental areas that prohibited wealth building and investment, and that was education, financial advice, and the overarching complexity and diversity of the investment options in our system. This Department of Labor rule will have a devastating effect on the African American community and on other lower and middle income because they don't have that money to pay up front with fee costs. And when you put a contract there for them to sign, they're going to run away. I know. I've been there. I've worked with the African American Chamber of Commerce on this. So what I want to ask you all are the Financial Stability Council of the United States government. Take for a moment and look at the most unstable financial caring in this country is in African American communities. Is it not too much for somebody on your committee to ask the president to hold off until we actually see just how devastating it is affecting African Americans? That's what I'm asking you to do. I asked Ms. White the other day at our meeting at Security Exchange, but she seems to have ceded her authority to the Labor Department. When we clearly put it, as you know, Mr. Watt, you were here. We wrote it into Section 913 in Dodd-Frank that was the domain fiduciary of the Securities and Exchange Commission. At no time did we hear from the Labor Department or ERISA talking about they have the retirement. And if they do, wouldn't it be respectful for them to sit down with the regulatory agency that handles financial investments, the SEC and FINRA, and work that out? I just urge you to examine these because the devastating impact is terrible. My paper, the Atlanta Journal-Constitution, I urge you to read it. Sunday's edition, front page of the Business, talks about the struggle of African American families to build and grow wealth. And the number one reason why it's so slow is they can't get the education or the information. Rich people investing, they don't have any problem. They can pay for that fee for service, most of them do. But when you get to annuities or trying to turn your life insurance into whole life or whatever, you need advice for that. Anyway, I urge you to ask the president to put a pause on this and let us see what the impact on the black families are. Now, Mr. Massad, I think I got time. We got a terrible problem with the European Union on this equivalency with derivatives. December 15th is the deadline. And I want to know, because it's going to have a devastating effect on our end users, on our exchanges and clearinghouses, if we don't get equivalency in terms of our regulatory regime with the EU, especially when they've given equal status to Singapore and other areas. What's the status on that, in that we're just a week away from the deadline?
Thank you, Congressman. They have pushed out that immediate deadline. I think we are still working in good faith to try to resolve this. I think we've narrowed our differences. I'm hopeful that we can do so. I, of course, believe they should have granted us equivalence some time ago, but I recognize the issues that they're concerned about, and we're working very hard to work them out.
Thank you, sir.
Time of the gentleman has expired. The chair now recognizes a gentleman from Ohio, Mr. Stivers.
Thank you, Mr. Chairman. I appreciate all of you for being here. I'd like to go on a quick tour of the segments of the financial services industry. How many of you believe, how many of the witnesses believe that small banks and credit unions caused the crisis in 2008? Could you raise your hand if anybody believes that? Okay, I would like to note that no one did say that. And you have an important role as a coordinating council of regulators as well. And I'm curious if you could go down the line, starting with Ms. White, and could you tell me how many hours in the last year you've spent discussing and identifying regulatory conflicts and unnecessary regulations that might be harming our community banks and credit unions, where better coordination could reduce unintended consequences and cost, and differing regulatory interpretations by agents in the field? Just how many hours this year the council spent talking about that? Just if you could each give me a number, and we could do this quickly.
I can't give a very accurate estimate. Those discussions have occurred at the staff level, but I can't say, I can't really give you.
You'd say zero.
I wouldn't say zero, but yeah.
At the staff level, okay. But on the council, that's what I care about. That's who you are. Let's keep moving.
I also could not give you a number.
Okay,
but
sounds like another zero. Keep moving, Mr. Woodall.
I think there's a definite figure, but I think there has been discussion leading up.
Okay, so some discussion. Nobody can put a number on it in hours. Ms. Maltz?
I would agree that.
You would agree you don't have any idea how many hours, but it's
no,
happened?
But I think it has
Okay,
happened.
let's keep moving. Obviously, there's a pattern here. Does anybody have a number? Will anybody give me any kind of number?
I quit keeping time when I left the practice
man.
of law, Mr. Stivers. So, you know,
I'm still keeping time, so let's move.
We spend a lot of time
got it.
discussing a lot of issues, and
Okay, I think we've
regulatory
got a
overlap is
pattern.
one of those, I think.
I appreciate it. I think we've got a pattern here. You're not discussing it enough at the council level. The staff is discussing it, but you need to discuss it. These are important community assets that dot the fabric of our country and the 15th District of Ohio. And these companies, small banks and credit unions, are struggling to keep up. Many of your field agents actually misinterpret regulations intended for big banks and put extra pain and cost on these small banks, and they're having real struggles. Let's move to regional banks. How many of you believe that regional banks, and I'll define those as kind of $50 billion to $250 billion. How many believe that those regional banks caused the crisis? Again, no. Oh, got a couple hands there, maybe?
Just to make the point for what it's worth, and
we're running out of time. It can be quick.
The regional banks generally are individually not systemic. I would point out that, as was mentioned earlier, the most expensive bank failure during this crisis and in the history of the FDIC was a $12 billion loss caused by the failure of IndyMac, which was a $30 billion thrift. So a regional institution can have a failure of one or more regional institutions can have a significant consequence.
They can, and I believe that. So let's talk about what you've done to use your regulatory flexibility that Secretary Lew says you have between trillion-dollar banks and $50 billion banks. Can anybody explain to me exactly how you've used that regulatory flexibility? Mr.
Congressman, the OCC supervises a range of institutions, small rural banks to globally active banks. We're very concerned about the regulatory burden, particularly on community banks. The FSOC is not necessarily the forum that we discussed reducing regulatory burden. We do that on the banking and credit union side, on the FFIEC, the Federal Financial Institutions Examination Council. We really are concerned about the impact. The AGRIPA process really is designed to reduce how we can reduce regulatory
I appreciate
burden.
that, Mr. Curry, and I want to talk about that, but we're talking about regional banks now.
Yeah,
Can you tell me how you've used the flexibility that
Definitely.
Secretary Lew says you have? Have you used it?
As
and if
a-
so,
Yeah,
how? Exactly how?
As the supervisor of a number of regional or mid-sized institutions, we place a great deal of value on collaboration and coordination with our other regulatory agencies, and I'd include the Fed, the FDIC, and the CFPB. It's really a regulatory imperative to make sure we're working together and not.
You haven't answered how you're trying to eat up time here, it sounds like. You have not answered one specific way in which you've used your regulatory flexibility. Could you give me one specific way? Mr. Gruberg. One way. That's all I'm asking.
As you know, Congressman, one of the consequences is a requirement of submitting a resolution plan, and we certainly, for the smaller
The
institutions.
tailored plan is the only true answer, and how that cuts a little cost, but they still have to do the CCAR stress test, the regular stress test. There are way too many things built in that you have the power to fix, and I wish you'd take a look at it. I didn't even get to non-bank financial entities, and my time has expired. But please look at those things. Thank you, Mr. Chairman. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight Investigation Subcommittee.
Thank you, Mr. Chairman. Thank the ranking member, and of course, I thank the august body of witnesses who have appeared today. In my years on the committee, I don't think I've seen quite the number of financial stability heads assembled at one time for purposes of questioning. So I thank you for being here. Mr. Woodall, much has been made of the fact that you are the only person on the FSOC with insurance expertise. Incidentally, is that the only area that you claim expertise in? Do you claim expertise in other areas to this extent?
I'll say being on the council is a learning experience. They're learning about insurance, and I'm learning about banking.
So you don't claim expertise in banking, but you are learning about it. Mr. Woodall, based upon what has been said, there seems to be an implication or an indication that only persons with insurance expertise should judge an insurance company. And I ask this because MetLife has appealed its case in the sense that it has filed in a district court in the District of Columbia, federal district court. Do you think that judge ought to be an insurance expert to hear the MetLife case?
I'm not going to make any statements about the MetLife appeal.
I understand. Well, I'll continue to ask you questions, and you continue to have no response. Do you think that the jurors who will hear the MetLife case, if we do have a panel of jurors, do you think that they all have to have insurance expertise?
Of course not.
Of course not. In fact, across the length and breadth of this country on a daily basis, we have jurors who are ordinary, everyday working people who hear complex cases involving antitrust, billions of dollars. In Texas, we had the Pennzoil case, lots of lay people there hearing a case. People hear these cases all the time and make life and death decisions who don't have expertise in a given area that the case happens to be focused on. Do you agree with this, Mr. Woodall?
Yes, I would say that
I think you do.
FSOC
Let me continue. It appears to me, Mr. Woodall, that the indication of only a person with expertise in a given area should be able to judge would lend itself to asking at least one question. Have you made any decisions with reference to banks since you've been on the FSOC?
The banking regulators are the ones that do that.
But have you voted? Have you had a vote on anything related to banks? Have you had a vote since you've been there on anything related to banks?
Not as such.
Not as such. Well, I don't have the time to drill down with that, Mr. Woodall. There's a way to get to the not as such answer, but I don't care to do it now. So you have voted as such on some things related to banks.
Well, obviously, when you get in financial market utilities.
I understand. So you have not recused yourself from issues related to banks. You voted because you're a Phi Beta Kappa from Kentucky. And as a Phi Beta Kappa from Kentucky, you can understand these banking issues, can't you?
Yes, and they can understand insurance issues.
And that leads me right to my next question. Thank you so much, Mr. Woodall. My next question is this. If you believe that a person only must have insurance expertise to sit in judgment of an insurance company on FSOC, raise your hand. If you think you only can do it if you have insurance expertise, raise your hand. Anyone? Let the record reflect none. But because I want the record to be perspicuously clear, let me ask the question another way. If you believe that you can sit in judgment of an insurance company and not be a Phi Beta Kappa from Kentucky, raise your hand, please, if you believe you can. All right, Mr. Woodall is the only person who thinks that you got to be a Phi Beta Kappa from Kentucky. I see his hand didn't go up. So, Mr. Woodall, I assume that I should now put in the record that you are a person who believes that you must be a Phi Beta Kappa from Kentucky before you can sit in judgment of an insurance company on FSOC. Should I put that in the record?
No, but I think
okay,
you should
that shouldn't go in the
that
record. So I'm going to take it from that comment, Mr. Woodall, that you join the rest of your colleagues and that the record should show that there is unanimous consent that you don't have to be an insurance expert to sit in judgment of an insurance company.
I'm not sure what an insurance expert is.
Well, I'm glad you said it because some people have claimed that you are, so my assumption is you don't know what you are.
That's because it was put in the title.
Well, okay, well, look,
Frank.
Mr. Woodall, by the way, let me share this with you before I end. Mr. Woodall, I want to make this very clear. I love you. Because sometimes it can appear that I don't love people because I have to ask the tough questions. And I regret that I didn't get to some other things. But God bless you, dear brother. I love you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Holgren.
Thank you, Mr. Chairman. Thank you all for being here, way over to the side here. But I'm going to address my first question to Chairwoman Matz, if that's all right. You said earlier that designation of insurers was not about life insurance activities, it's about financial activities. My understanding was at the time of the designation, which, again, my records show June 30th, 2013, the reference date for much of FSOC's analysis, 98% of MetLife's consolidated assets, 96% of its liabilities, and 95% of its revenues were in these highly regulated insurance subsidiaries. So I just wanted to make sure I understand the basis for your decision. Are you saying that FSOC analyzed only 2% of MetLife's consolidated assets and only 4% of its liabilities and 5% of its revenues? These activities are outside of regulated insurance entities at the company, I believe, and found that those assets alone to be systemically important and a threat to the financial system. Is that your testimony?
Well, I do want to say that we cannot comment on MetLife, but in terms of our designation of other insurance company, we do look at how their balance sheet and off-balance sheet activities are interconnected with other systemically important institutions.
I'm going to stick again with Chairman Matz on this and then open it up to others as well. As all of you should know, insurance companies are extensively supervised by states. Despite the existing regulation, FSOC has designated 3 insurers as systemically important. Chairwoman Matz, could you provide an overview of how and why you determined the state insurance regulation, and in particular, the state guarantee system for failed insurers is ineffective?
Thank you for asking that. I don't think any of us, and I can't speak for anyone, but on this I would say that I don't think any of us think that the state insurers are ineffective. But our mandate is to look at how the activities of the insurance company should affect the financial stability of the United States. They're really looking at the effect on policyholders. It's a very different direction that they're taking.
With making that determination of what you should pull away from the states, again, clearly legislatively, most authority of regulation for insurance companies is with the states. I would argue both for protection of policyholders, but also protection of policyholder would, by definition, state, financial stability of that company. Those would be directly related. Those aren't separate issues. So what specific information analysis did you, as a voting member of FSOC, rely on to reach the determination that that should be separated out, that states were unable to handle this?
As I said, they have a different mandate than we do. They're looking at the institution and the solvency vis-a-vis the policyholders. We're looking at the institution and its interconnectedness with other institutions and its ability to threaten the financial stability of the United States. It's a different mandate. It doesn't mean that they're doing their job any better or worse than we are, or vice versa. It's just a different tack that they're taking.
As you're making this decision, was there an independent analysis done by your agency?
An independent analysis of?
Again, standing, I guess, of these insurance companies, their ability, if there was a threat nationally to financial markets, or I would say also to policyholders? Was there an independent analysis done by your agency to make the determination again that the states weren't capable of doing this, that this was something that you all needed to do?
We rely on the FSOC staff. We do not do an independent evaluation, no.
Let me switch in my last minute here. A little discussed provision of Dodd-Frank Act, Section 170, directs the Fed on behalf of and in consultation with FSOC to issue regulations setting forth criteria for exempting certain classes or categories of non-bank financial companies from heightened Fed supervision. However, to date, no such regulations have been issued. This requirement represents a tool Congress created to delineate between those entities that pose systemic risk and those that do not, and provide clear criteria for institutions on how to conduct their business and structure their operations in such a way as to be non-systemic. Chair White, in the last few seconds I have, why has this provision never been used?
I really can't answer that. I have to come from the Fed initially, at least.
I guess in my last seconds, just a show of hands following in my friend from Texas, who among you has advocated for a class of financial company to be exempted from heightened supervision? If you could raise your hand if you have advocated for a class of financial company to be exempted from heightened supervision. For the record, none raised their hand. My time has expired. I yield back, Chairman.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty.
Thank you, Mr. Chairman, and thank you, Ranking Member. Let me associate my opening comments with those of my colleagues. As someone relatively new, I've certainly never seen the number of people, which is not as important as the work and the service you do. So thank you for that. We've heard a lot of questions about what you don't do. What's interesting to me is I listened to the example about what you would provide as it relates to giving us information, and I think the analogy was to us getting classified information for ISIS. Well, we certainly know from everything we have read and we've heard that our country is in trouble. So you were asked, and given that analogy, do you think, since your role is to protect the financial stability for us, are we in financial crises right now as we were, let's say, in 2008? So I'm trying to get, are we like ISIS is to a threat in your world? And that's a yes or no if you could just go down the panel. Are we in that same kind of threat in financial? Mrs. White?
No, but I think we can't be complacent.
Yes or no, straight down quickly.
I would agree with Chair White's statement.
Me too.
No.
No.
I agree. Okay.
No.
Okay, I have an insurance question, but I'll come back to that, Mr. Woodall, since you have been asked so many questions about this. I also would like to associate, for the sake of time, myself with the words of Congressman Scott from Atlanta as it relates to not only the issue he talked about, but more importantly about Black wealth or minorities. I am very concerned, and I know many of you have OMWI boards, but my question is beyond OMWI because I'm not pleased with the answers that I have been given by you all with OMWI. While it's a big deal to me in Section 342, I don't think people have taken it as seriously as we should. With that said, as a group, as you look at making your projections, as you evaluate where we should be financially, can at least three of you tell me what you do with minorities and more specifically African Americans as it relates to banks, financial institutions? How are they included? Because you make projections that affect us and our constituents. And so I'm concerned. Can anyone address that quickly?
I'll start in terms of what we do with minority-owned institutions and populations. In terms of minority depository institutions, I have an advisory committee that advises me on the issues facing those committees, how we can help alleviate them through technical assistance and other means that are mandated by statute. As a bank regulatory agency, we also enforce the Community Reinvestment Act, which has a direct impact on low to moderate income communities. and we have active outreach efforts associated with that with both banks and interested groups.
Okay. Anyone else, quickly?
I would add that we enforce the Equal Credit Opportunity Act. We work with the Justice Department on those matters. We recently resolved the largest redlining mortgage lending matter in the history of this country. We've had significant matters in auto lending discrimination and credit card as well. This is an important means of making sure that everybody across our society has equal access to credit and aren't discriminated against on the basis of race and ethnic origin.
Okay, we'll take one more.
And Congresswoman, I just mentioned we also have an extensive program as required by law to support minority depository institutions. The FDIC also has an advisory committee on economic inclusion, where one of the things we focused on is asset building for low and moderate income families. And certainly the mortgage crisis, as you well know, had a disproportionate impact on minority households and African American households.
Thank you. If Congress were to reduce the ability of FSOC to perform its statutorily mandated function of overseeing financial markets for threats to stability, how could that impact the U.S. Economy? We'll go to the other end. Ms. White?
Well, I mean, it would defeat the entire purpose of FSOC, which is a very important one, which is to look out for the financial stability of the U.S. financial system.
Okay, Mr. Chairman, Commodities Future and Trading Commission. Later today, the committee will be marking up a data security-related bill, which I'm sure should be very interesting to us. I'm interested to hear what measures specifically FSOC has taken to facilitate dialogue to help us protect that.
Well, I think generally FSOC has taken the issue of cybersecurity, broadly speaking, very seriously. It's listed that as a primary concern in its annual reports. FSOC also serves as a very useful way for all of us as members to compare notes and coordinate what we're doing individually in our agencies.
And do we have any, my time is up, I'm sure. Do we have any best practices developed, yes or no?
I think most definitely so. A lot of us are very focused on those best practices issues. We're in our own agency. I hope that we will come out with some standards specifically on that.
Thank you.
The time of the gentlelady has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Mr. Chairman. Mr. Woodall, I have to just follow up on what my colleague from Texas was pursuing. And as a litigator of 25 years, I know that the trier of fact, whether it be a jury or a judge, must rely on evidence brought before them, and that evidence, of course, is in the best form when it is brought by an expert, and when that expert testimony is uncontroverted, then it becomes clear matter of fact that that opinion should gain the day. Clearly, on this board, on FSOC, you are eminently qualified and by far the only person who could be considered an expert in the insurance arena. You have experience not only academically, but also practically as an insurance commissioner. So I have to ask, what was it, in your opinion, that drew FSOC to disregard uncontroverted expert insurance opinion and designate MetLife and Prudential as SIFIs?
Well, I think what you outlined might be a professional disagreement. I have a lot of respect for all my colleagues. We had a very hearty debate. I listened to them, and they listened to me. And
I don't think they listened to you is the problem.
To disagree.
And I think that there might have even been some influence in reading your testimony about not being at the table with the IAIS. Is that a factor that may play into the domestic category of creating these SIFIs, these non-bank SIFIs, because they're more concerned about the international process than they are the domestic process?
Well, but my job is to try to monitor the whole insurance industry international so I can give my recommendations. There is a statutory provision that every member is supposed to monitor developments in international insurance matters.
And they haven't been listening to you, though, have they? I mean, that's clear in your testimony.
Well,
and I guess
I voted with them on AIG. It was a unanimous decision.
But with regard to the designation.
For Inmet, right.
You know, I mean,
these were companies that we had not had the type of problems with during the crisis.
Right. I mean, there hasn't been a run on life insurance, has there? I mean, are people going to all of a sudden go and cash in their life insurance policies? Because if they are, then our serious consequences to our economic structure that are way out of line. Chair Matz, 90% of the Prudential's balance sheet assets and liabilities are in regulated insurance companies. It engages in no proprietary trading, and its limited securities lending business was fully collateralized. What would be the basis for your decision that Prudential poses a risk to the financial stability of the United States?
Well, we look at the overall construction of the company's assets and liabilities, their balance sheet and off-balance sheet activities. And in their case, we were concerned about their derivative position.
And you testified, I think, earlier to Chairman Luchtemeyer's questions that you relied on staff, their expertise of the staff. And I think, Mr. Cordray, you went on to say even further that everyone on FSOC has their own expertise and that FSOC members also rely on the expertise of FSOC staff, among others. This begs the question, who are the other people FSOC is relying on to make these determinations, if not the panel, and who are the staff? And what is their expertise in such arenas as insurance? Yes, sir.
So I think we rely on FSOC staff. We rely on the analysis done by them. There are people loaned from the member agencies of FSOC who do work on this, and then we talk to our own staffs. But to go back to the point my colleague, Mr. Woodall, made a moment ago, in terms of insurance companies, there seems to be a lot of dissatisfaction here with the designation of MetLife and Prudential.
Yeah, I would think so.
AIG is also an insurance company.
Yeah,
It's designated by this body, and it had tremendous reach.
But they had a diversified
risk,
portfolio
complexity.
also, not unlike
That's right.
traditional
And there
insurance
have also been a number of insurance companies that meet the $50 billion asset threshold that have not been designated. So it's a spectrum here, and it's a judgment that has to be made along that
But even then, your FSOC staff, I doubt if you have anybody as eminently qualified as Mr. Woodall, and if you're relying on those experts as opposed to the member, Mr. Woodall, then I think that there's some problems there. But let's talk about asset managers. You know, what are we doing here designating asset managers as SIFIs when in fact they are basically brokers? They're not carrying the assets. And in fact, the impact that it'll have on mom and pops and retirees, because of now what they're going to have to do is pay fees in order to justify why they're brokering with a SIFI when we have not even established that an asset manager should be a SIFI. Yes, sir.
We have not designated any asset managers as SIFIs. That is
you
a
got
matter
them in
that's
stage
under
2 already.
consideration.
They learned through
Under
a Wall Street
consideration.
Journal article.
Under
Don't you think it would be
consideration at the
more
council.
prudent to allow these asset managers to have the ability to correct whatever may be wrong so that they can save not only the financial system but also those with whom they serve, instead of waiting until the opportunity where a collapse may occur that you seem to foresee?
That's a point of view, and these are the kinds of issues that are under
If I
consideration
went to the
by
doctor and knew if
council.
I had something wrong, I would want to be diagnosed and treated then, not until I was on life support. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, Mr. Chair. Mr. Woodall, I think I'd like to direct this to you, if I may, please. Over the last couple of I'm over here. Over the last couple of years, we've heard a lot of witnesses, and no small number of the members of this committee indicate publicly and explicitly that receiving a SIFI designation was locking in an unfair competitive advantage. It seemed to be premised on the idea that lenders would be willing to extend debt to them at a discounted rate. I'm having a hard time squaring that circle in the face of the fact that everybody who's a target for designation fights it tooth and nail, and secondly, the action of the S&P recently to downgrade the debt rating of, I think, 8 financial institutions. What's your impression? Is this a good thing to be SIFI designated? Is it a desirable thing by them? Does it, in fact, lock in a competitive advantage?
It's a good thing if they are truly systemic and present a systemic
Is it a
risk.
good thing for them?
But we need to know, and they need to know, what activities they're doing that make them a significant.
Does it give them a competitive advantage?
Yes, we've talked about that. It can give them a competitive. We
Why
don't
would they
know
fight
yet.
it?
We don't know yet because the Fed hasn't even come up with what their capital standards are.
Why would they fight it, and why would S&P downgrade them?
I think they don't know what the future is. They don't know how high their capital requirements are going to be, and they don't know how it will affect them, and they don't know what businesses that they sell that they have to get rid of.
TBD. Director Watt, as I pursue this, please remember I respect you. I'm not going to go quite as far as the gentleman from Texas, but I have affection as both a former colleague and somebody I respect. Since you've taken over, I've written you 2 letters, or signed on to 2 letters. The first had to do with the forced marriage of the Seattle and the Des Moines Federal Home Loan Bank. And I specifically ask that you ensure that the new bank's affordable housing program distribute its funding equitably throughout the combined district. And that's something that when the bank was just in Seattle, they ensured. And in fact, the Des Moines Bank, the new consolidated bank, came out with its 9 criteria for distributing funds and made absolutely no mention whatsoever of equitable distribution. I cannot exaggerate to you the depth of my disappointment in this. I convey it to you. I'm not letting go of this, and I am deeply disappointed that there was not more attention paid to this basic principle. The second letter that I sent to you had to do with concerns about the proposed rule to limit membership. I think 66 of my colleagues got on. The rule came out. We hear rumors that it's not going to be changed. I've signed on to legislation with Mr. Lukemeyer, Mr. Carney, Mr. McHenry to sponsor a bill to stop it. Now, in a private meeting, I had put a question to you, which I now put to you publicly. And I'm asking you to respond personally, not necessarily with your agency hat on. You are a longtime former member, much respected, of this committee. Given the forced marriage between Seattle and Des Moines, given the blowback and apparent disagreement about the proposed membership rule, is it not time that the Congress take a look at the basic structure of federal home loan banks? It has not been touched in 80 years. For all practical purposes, its roots are the same as when they were created. I believe that in 8 decades, circumstances have evolved, and it should be up to us to take a look at that. In fact, the disagreement you and I had privately was, I think it should be up to you or your agency to bring forth ideas about how we might do that. Your reaction, please, sir.
Well, I think there's an ongoing obligation of Congress to look at every aspect of the financial services industry and the housing finance industry. And I think there are important needs that could be looked at in the Federal Home Loan Bank system.
Thank you. Comptroller Curry, you are the sole director of an agency that is not subject to appropriations. How many times have you testified before this committee?
I'm sorry, is your microphone on?
3 times.
Yes, 3 times.
Over what period of time?
Since my appointment in 2012.
Director Watts, same question.
I come whenever you call me. I've been here one time.
One time. Director
sworn in.
Cordray, how many times?
I don't know here, but in front of Congress, more than 50 times the Bureau has been called to testify.
I think the point is clear. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman. Appreciate each one of you being here. I guess, Mr. Woodall, you and I think probably engaged in a discussion at a previous appearance you made in front of this committee talking about some of the downstream effects of the listing of AIG and Prudential and MetLife. So that's going to have an effect on the insurance market itself, will it not, if I remember from our previous discussion?
Yes.
So we in the U.S. enjoy competitive advantage throughout much of the world, and coming from the business world, specifically repairing oil wells downhole, which is filled with liability, we utilize that insurance market to great advantage to allow us to create jobs, to do a better competitive effort than some of our friends overseas could do. And so will there be downstream effects from any actions you all take regarding the too big to fail? Will there be effects in the insurance market?
Well, yes, I mean, you use terminology, but obviously if someone has increased regulatory expenses, it's going to affect how they operate in the market.
So there's a possible threat from what you all do to the market. Mr. Masad, have you all discussed that in the FSOC meetings?
I guess, Congressman, I wouldn't characterize it that way. I would point out, for example, that what we do can protect people. When we consider AIG, for example, this government had to commit $182 billion to prevent the collapse of that company, which would have probably taken us into a worse Great Depression than what we had in the 1930s. Fortunately, we were able to get all that money back.
What about MetLife and Prudential?
Congressman, with all due respect, I was not there for the prudential designation with respect to MetLife. That is a matter under litigation, so I don't think it's appropriate to comment on the reasons for it.
Ms. White, would you have a comment on that? In other words, you all as FSOC, your underlying call is to prevent excessive risk to the U.S. financial system, and what I'm saying is that there are certain financial risks to what you all are doing, to the actions you all are taking. So, Ms. White, did you all discuss the potential downside of what you're doing here and how it might affect the market? And you've heard the guy that made his living regulating insurance and living in the insurance, and sometimes staff have not had that on-the-ground experience. So regardless of what anybody else says, do you all sit quietly behind the doors and say, hey, we ought to really take a close look at what we're doing?
Well, I think we have to carry out the mandate we were given, which is basically to identify and address systemic risk to the financial system. I mean, that's in financial stability of the financial system.
But you don't ever think that you all as the government, you don't think that you as an agency could be the systemic risk yourself?
Well, I mean, I think you want to consider all factors, and certainly when we do our rulemakings at the SEC, we directly consider, all of the impacts. But I think in terms of, I think we do consider and discuss factors, a wide range in FSOC too, but, our primary responsibility is to carry out the mandate we were given to.
Well, the mandate is to watch, excuse me, I keep shifting back and forth.
Well,
the mandate is to watch for systemic risk, is that right?
It's to identify and address systemic risk to the overall financial
system. So I'm
system.
saying that if you all, according to Mr. Woodall's discussion back some time and kind of reiterating now, you all could be the systemic risk that you're trying to avoid if you're not very careful, because this insurance market is extraordinarily thin. If you're watching, I don't mean to be rolling in other stuff, but if you're watching people bail out of the insurance market in healthcare right now, you understand that I'm talking about. We have disrupted an entire insurance market, and before you all do something that causes the same evacuation out of the insurance, just remember the poor saps out there in the field like myself who are just trying to buy insurance off the open market to where we could do our business. And it could be that you all are the problem that causes that market to disappear. And that's my point. I would hope that you all would have more thorough discussions about the problem that you all represent instead of the systemic risk that maybe you ought to be identifying out somewhere else. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. The chair wishes to alert all members that there is currently one procedural vote on the floor. There are 11 minutes remaining in that vote. I will recognize the gentlelady from Missouri. Members may want to go vote and come back. And then after the gentlelady from Missouri, we will recess briefly for the vote. Gentlelady from Missouri is recognized.
Thank you, Mr. Chairman, and thank you all for being here. I'd like to quickly associate myself with my colleague across the aisle from Georgia, Mr. Scott, about this very misguided administration's rule letting by the Department of Labor on the fiduciary issue. I would encourage you all to speak to the President and his team on this issue, too. He did not seem interested in my concerns last night at the Christmas party. I am particularly interested in knowing the role that the international forum known as the Financial Stability Board has played with regard to decisions about domestic matters made by FSOC. Due to the kind of non-transparent nature in which FSOC conducts its business, it can cause one to question, I think, whether our U.S. regulators are really fighting on behalf of the interests of the United States of America when they are at the international negotiating table, or whether we are simply letting international counterparts make important decisions for us. Mr. Woodall, in your dissent to Prudential's SIFI designation, you made the point that the international and domestic designation processes are not entirely separate and distinct. Specifically, sir, You noted that an unnamed U.S. national authority agreed to the international designation of Prudential before the company's hearing and financial determination before FSOC. Could you please be specific and elaborate? Who is that? The national entity, national authority.
Yes, the national authority. Well, there are three at the FSOC, the FSB, there are three national authorities, Treasury and the Fed and the SEC.
Yes, and who is the unnamed authority that agreed to the international designation of Prudential before the company's hearing, and final determination before FSOC?
Well, that's hard to say. As far as I know, actually, before the hearing in Prudential, the Treasury notified Prudential that they had been designated as a global SIFI.
Before their hearing, before their final determination, before FSOC, Treasury, if I understand your testimony, let them know that they had been designated.
That's my understanding.
All right, this seems questionable. As you stated, the U.S. representatives on the FSB are Treasury, the Fed, and the SEC. They're not insurance regulators, as has been pointed out by so many of my colleagues, nor are they necessarily Phi Beta Kappas from Kentucky. Meanwhile, the FSB's membership is dominated by banking regulators who know little about the insurance industry. Does it concern you that those regulators are the only U.S. representatives in the room when decisions are made about insurance issues, sir?
Yes, I think that the CFTC and that the FDIC should be in the room at the meetings of the FSB, and I think insurance regulators should be in the room if they're making decisions that are going to affect the businesses that they regulate.
Thank you. Given the sequencing of FSB designations and then later FSOC SIFI designations, how can U.S.-based insurers be confident that their designations are the result of a domestic decision rather than an international process that isn't accountable to the U.S. policymakers like us?
Well, as I said, they are technically separate things, but they're not.
They're not. They're not accountable to U.S. policymakers. Thank you. Can you describe what attention or consideration FSOC gives to designations by the FSB?
No direct. It's not mentioned. It's not mentioned in the discussions because we try to base it on what Dodd-Frank says.
Do you believe that your colleagues would feel comfortable disagreeing with a decision or challenging a decision made by the Fed, the Treasury, and the SEC at the Financial Stability Board?
Well, of course, there's still just 3 votes on the board. The board, the Financial Stability Board, is not an organization that this Congress created by a treaty or any other statutory thing. It's kind of an ad hoc group.
Absolutely, it's an ad hoc group.
It's really self-appointed.
Do you believe that your colleagues would vote to de-designate any of the insurance companies if such companies were still designated by the FSB?
I would hope so.
One last question. Since everyone has said that they, and I have much time left, they rely on FSOC staff for info, is there a memo or analysis that is distributed to members before a vote? Who writes this? Is it Treasury? Is it the Fed? Would you allow the committee to view any of these documents? Anybody?
Well, it goes through a committee called the Non-Banks Designation Committee, and it goes to the Secretariat, which is within Treasury, and you're looking at 600-700 pages sometimes in these memos. They're more than memos. It's quite extensive with a lot of good work done by the top economists at the Fed and other agencies.
Thank you, sir.
Time of the gentlelady has expired. The committee will now recess for the vote pending on the House floor. The chair expects the recess to last approximately 10 minutes. The committee will reconvene immediately after the vote. The committee stands in recess.
Yeah.
Glad to meet you, Ted Knudsen. I'm a reporter with Financial Advisor magazine. You said here and you said in your dissent that CEO
panel will take their seats. Chair now recognizes the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. And Mr. Woodall, since you've been the topic of much conversation as a Phi Beta Kappa from Kentucky, as a fellow Kentuckian, I'm going to try to leave you alone for the most part today. Let me start with some of our bank regulators, our prudential regulators, and just note that at a macro-prudential level, FSOC and our banking regulators have participated in international agreements with the Financial Stability Board, Basel, and other forums. And the main difference between U.S. requirements and those promulgated internationally is that it seems that our domestic standards are more stringent than our foreign counterparts. So just a few examples. A capital surcharge on global financial firms nearly double the international standard. Supplemental leverage ratio that is double adopted internationally. A liquidity coverage ratio that is more restrictive than the international standard and arbitrarily punishes certain products like municipal securities. A total loss absorbing capital rule that goes beyond international standards. OTC margin requirements that are considerably more punitive than international standards. So the question is this for Ms. Matz, Mr. Watt, Mr. Gruenberg, Mr. Cordray, and Mr. Curry. The question is, I assume that you all agree that these prudential rules and other reforms have improved safety and soundness. And if you agree with that general proposition, raise your hand. So all of you agree that these new prudential rules enhance safety and soundness. A follow-up question, do you believe that the benefits of these new prudential rules outweigh potentially the cost to international competitiveness, given that we have higher standards than that internationally? Okay, so most of you agree with that. When combined with Volcker, financial institutions seem to be making a couple of changes, and the regulations are producing a couple of results. One is that there's a migration of activities out of heavily regulated banks and into much less regulated non-bank financial firms, the so-called shadow banking system. And I want you to address that. But also, there is much talk about illiquidity in the markets, institutions dropping certain products and services, pulling back from market-making functions critical to investors, extension of credit, affecting various fixed income asset classes in different ways. So my question to some of our market regulators, Mr. Massad, Chair White, the FSOC annual report acknowledges that there are changes in terms of reduced liquidity in the capital markets. The Office of Financial Research is corroborating this. Certainly, there's other indicators. The Center for Financial Stability found that market liquidity has declined by 46%. And as you all have already noted, and Mr. Curry's noted, that this potential lack of liquidity that is resulting from regulation could mean that financial markets have less capacity to deal with shocks and would more likely seize up in a panic, just as they did in the 2008 financial crisis. So given that our bank regulators are making the case to FSOC that this is good for financial stability, and yet we see a liquidity problem developing, from your perspective, what do you make of all of this?
Well, I think it's. We talked a little bit about this. I think at my last hearing. I mean, I think it's a concern of all of us in terms of significant reduction in liquidity. Obviously, there are rules that have very beneficial purposes that may or may not be causing that. We do analyses to see whether. Volcker, for example, will report quarterly to this, committee. The Volcker rule, we've not determined that it's, having a negative impact on liquidity. When we talk about shadow banking, I think we have to be careful too. I mean, that covers a broad swath. I mean, a lot of the things that fit under that category are heavily regulated, by the capital markets regulators. So, but I think, bottom line is that we're all and should be very concerned about impacts on liquidity.
Well, I think we should look at regulation as a cause to financial instability as a result of the lack of liquidity that we're seeing developing in the marketplace. That is something that FSOC should be paying attention to and revisiting some of these regulations to the extent that they do compromise financial stability. Finally, let me just go back to Mr. Watt really quickly. The GSEs are exempt from Mr. Cordray's QM rule. They're exempt from capital and liquidity rules that I'm talking about. Agency MBSs are carved out of the Volcker rule, and agency MBSs are some of the few cash and cash-like equivalents that banks need to hold to comply with these capital and liquidity rules. My question to you, in my limited remaining amount of time, is why are these standards good for the private sector but not for GSEs under your oversight, and why have a double standard if, as you signaled by raising your hand, that these capital requirements are important for financial stability? Shouldn't they be important for the GSEs as well?
If they were not in conservatorship, I think you would be absolutely right.
Well, why should we continue to have the risk on the taxpayer?
Well, because we continue in conservatorship because the legislative branch has not acted on GSE reform.
I think we should look at that double standard, and I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Delaware, Mr. Carney.
Thank you, Mr. Chairman. Thank you to the ranking member and to everyone who's here today. This is the biggest panel that I can remember that we've had before us. Part of our responsibility, I think, today for today's hearing is oversight of the FSOC. And as I understand, I was not here when Dodd-Frank was passed. The primary responsibility of the FSOC was to identify emerging systemic risks. And I'd just like to hear from many of you what you see out there as those emerging risks, and can you share those with us? Why don't we start with Mr. Gruenberg and go to Controller Curry in terms of your responsibility as part of the FSOC. What are the emerging risks? What are the systemic vulnerabilities that you're seeing out there?
The annual FSOC report outlines a series of systemic risks to focus on. Interestingly, in this report, the lead risk that it cites is cybersecurity and the potential consequence vulnerabilities relating to cybersecurity could have for the functioning of the financial system, and that certainly has been a focus of discussion and attention by the FSOC, and I frankly think by each of our agencies individually. I'd also reference...
Is there anything that we should be doing or looking at with respect to providing you with the necessary tools? We're going to be talking about a data breach bill later today.
I know the Congress is considering legislation to facilitate information sharing, which I think is one of the critical issues in terms of being prepared to deal with the cyber incident. So I think there is a significant role for the Congress and certainly for all the agencies at this panel working among the regulatory agencies as well as with the law enforcement and national security communities. It really is going to require...
The classified briefings that we've had are pretty scary, frankly. And the attacks are coming on a regular basis, on a daily basis, and frankly, it feels to me like we're fortunate that we haven't had a more significant attack than what we have had, and I know that institutions are dealing with it on a regular basis. Controller Curry, what would you say in terms of emerging risks or existing vulnerabilities?
I would agree completely with Chairman Gruenberg. Cybersecurity is a #1 concern, both as comptroller and as a member of the FSOC. I think the ramifications of a successful attack on the core system of a financial institution, regardless of their size, could really undermine public confidence in our entire banking system. And that's really why it's an imperative from a regulatory standpoint to make sure all of our banks, from the smallest to the largest, are prepared to repel attacks and are in a position to respond as quickly as possible in the event of a successful intrusion. The chairman also mentioned, and it's in the FSOC annual report, increased risk-taking in a low-yield environment. We are very concerned about the decisions that the financial institutions we supervise are taking today, whether it's to go long or to get into activities that they're either unfamiliar with or are not prepared to deal with the risks that are inherent in those activities. We think that is a potential emerging risk for individual institutions and for the system.
Thank you, Chair White. Anything that you'd like to add?
No, I think you can't emphasize enough the cyber risk. I mean, it's not a coincidence it's listed first and the emerging risks in the FSOC annual report.
Thank you, Director Watt. You and I have had some conversations about the last subject that you talked to Mr. Barr about with respect to the GSEs. And I know it's been your view that you're waiting on Congress to act. What vulnerabilities exist there? I mean, increasingly, the taxpayer or Freddie and Fannie are guaranteeing those mortgage-backed securities. What's your view of the sense of urgency around that issue?
I think we've been in conservatorship, Fannie and Freddie, for 8 years. It is the longest conservatorship that has ever occurred under government control. And while the risk of the work that we are doing is much, much less now than it was at the onset of the meltdown. Staying in conservatorship is just not sustainable. You have a high risk of losing the most qualified people to the private sector. It's just,
so we should,
I could keep going on.
We should do something. We should act.
You should act, yes.
Thank you, Mr. Chairman. I yield back.
Time of the gentleman has expired. Chair now recognizes gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman. Mr. Woodall, your criticism of the MetLife SIFI designation process is a matter of record and has been discussed at the hearing today. Your well-founded concerns are shared by many of us. Ultimately, we should all ask ourselves whether it is wise for people with little or no experience in a given industry to be given the power to make significant consequential decisions such as SIFI designation. There's a broader question as well that I was hoping to get your thoughts on. Many of us are concerned that American regulators are ceding responsibility to the FSB, which is composed of central banks, finance ministers, and regulators from around the world. Given our shared misgivings about, for instance, FSOC members without insurance experience deciding to designate an American insurer, shouldn't we also be concerned about letting foreign regulators who lack experience in the American financial services industry and who act in the best interest of their respective countries take the lead in regulating our financial firms?
Well, that's a point that's been discussed quite a bit, and a lot of it goes to the fact that the European insurers have a lot different background. They have a different accounting system. Their products aren't the same. Now they're pretty well united with their Solvency II regulation, which goes into effect next year. And they're working on equivalencies as to whether we're equivalent. There's been some temporarily equivalencies given, but if we don't get equivalency, it could increase the cost of our companies doing business in the EU countries tremendously.
One of FSOC's most basic authorities under Section 112 of Dodd-Frank is to make recommendations to the Fed concerning which heightened prudential standards should apply to non-bank financial companies. Yet to date, the FSOC has not done so. It would appear that FSOC is putting the cart before the horse, designating companies for heightened supervision, but making no recommendations for what those heightened requirements must be. A basic principle of regulation is that the benefits of imposing a regulation should outweigh the costs associated with doing so. Designating a firm for heightened supervision is not without costs. It is a serious matter that impacts firm behavior and may have even broader repercussions for the financial services industry as well as consumers. Chair White, how is it possible to ascertain the costs and benefits of designating an insurance firm as a SIFI if the Fed has not yet prescribed the heightened prudential standards that will apply to designated firms?
Well, again, I go back to sort of the primary mandate of FSOC, which is to, identify systemically important financial institutions that could impact the financial stability of the U.S. financial system. I do think, and now I think the Fed has actually, I think adopted, if I'm right, but certainly put out for notice and comment, and I think adopted standards with respect to GECC. So that's, that's there now, but I certainly understand the point that you're making in terms of if you don't know what the standards are that are going to be applied, it's obviously a part of your analysis that you can't do. I don't think we're obligated to do it, and indeed, I think we're obligated to deal with the issue of systemically important institutions in the first instance and not wait for that, actually.
Well, wouldn't it is a good idea, wouldn't you agree, that a basic principle of regulation is that the benefits of imposing a regulation should outweigh the costs associated with doing so?
Again, I think the premise of the responsibilities of FSOC is what a tremendous cost the financial crisis was, and to try to prevent that, one of the tools that FSOC has is the systemic designation powers. However, I mean, I think, speaking for myself, we certainly want to act on full information, including that.
Director Watt, is the FSOC evaluating the Fed's historically accommodative monetary policy stance to see whether that policy has led to excessive risk-taking in the financial system?
Not directly. We are always evaluating every decision that all of these regulators make, but we don't oversee the Fed.
Do the Fed's destabilizing monetary policies get a pass from the FSOC because the Fed chair sits on the FSOC?
Well, that assumes that they're destabilizing. I mean, I wouldn't assume that. That's your conclusion. But
so the Fed hasn't taken, or the FSOC isn't taking a look at the Fed's balance sheet, for example, that has gone from $800 billion to $4.5 trillion over the
That's not in the jurisdiction of FSOC.
Thank you. The Chairman, yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Thank you, Mr. Chairman, Ranking Member. I want to thank each of you and your staffs for your comprehensive and insightful written testimonies. And I also want to thank you for your service on the Financial Stability Oversight Council. We've all learned the painful reality that markets do not regulate themselves, and a nation as powerful as ours must invest in regulation that identifies and responds to emerging threats to our stability. And so your report, 150 pages, details the Council's unprecedented progress to protect our financial system from risk and to prevent another economic disaster from happening, which I remember very well. I wish everyone running for president would read it. Maybe then we could have folks talk about how to really understand how to protect our economy and be successful in that effort. So my first question is to Controller Curry. It's been a while since you've been before the committee. I want to welcome you back. Thank you. And since you're here, I want to ask you again about a topic that you and I have spoken about in the past, and it is the issue of Somali remittances. And our financial institutions are regulated by the OCC closing accounts of money services businesses serving Somalia due to compliance costs, reputational risk, inability to cover the costs, lack of clarity in exams, or for other reasons.
Congressman, as we discussed, I think there are a variety of reasons why individual institutions are making determinations about what their risk tolerance is under the Bank Secrecy Act and the anti-money laundering statutes. Those are some of the factors that I believe some institutions are making. In terms of regulatory clarity, we've tried to make clear what our expectations are. We did put out in 2014 additional guidance on dealing with money services businesses, but ultimately it's the decision of an individual institution whether or not to do business with an individual business or individual.
I just want you to know the Somali Parliament, I've had a chance to talk with some of them. They are passing a anti-money laundering, anti-terrorist financing law. They haven't passed it yet, but they're working on it. That's coming up. They opened up their embassy here in the United States. And I believe that the more stable that country is, the less susceptible it will be for terrorists to come and set up shop and try to operate out of there.
I think those are very good improvements. As we discussed, it's important that there be a strong local banking system and a regulatory system overseeing its compliance with important laws like the BSA.
Yeah, thank you. Mr. Watt, always a pleasure to see you. Very proud of you and the work that you do. Welcome back to the committee. It must be weird to be on that side of the divide. But anyway, I just want to say to you, the report calls for a comprehensive legislation to address the conservatorship of Fannie Mae and Freddie Mac. It also urges Congress to clarify the future role of the federal and state governments in mortgage markets. While Congress has not acted on any particular proposal regarding the GSEs, I am interested in what your current policies are doing to improve credit access to African American and Latino borrowers. I have a chart up which I'll direct your attention to that. And as shown by the chart, we know that the majority of new households are going to be African American, Latino Pacific, and Asian Pacific American, yet they seem nearly shut out of the mortgage market now. GSE loans to African American borrowers in 2013 were about 2.2%. GSE loans to Hispanic borrowers in 2013 were about 5.8%, both low. What policies can GSE implement post-conservatorship to improve access to credit for African American, Latino, and Native American borrowers that Fannie and Freddie cannot implement now?
You're asking about post-conservatorship or what we're
What can
doing?
they do? What is it that might be done later that can't be done now? And, you know, I'm basically asking, how do we make progress on this?
Well, a lot of what can be done after conservatorship, it depends on how GSE reform is done and what the rules of the road going forward are. Part of the challenge of being in conservatorship is one of the things I've found to be true is that lenders price uncertainty. And right now, they don't know what the future is. As prices go up, there's a price to uncertainty of what the future holds in this area. So I mean, there are a number of things that need to be done to address this because we need the availability of capital for people to be either homeowners or affordable renters.
We'll
Time of
follow
the
up. Thank
gentleman has expired. The chair now recognizes the gentleman from Arizona, Mr. Schweikert.
Thank you, Mr. Chairman. Just first conceptually, because it's been sort of floated around a couple times. In many ways, when I read many of the articles about what you're all doing, it's a discussion of, are we fighting the last war and the concentration of risk of unintended consequences. You know, we have our Section 113, you know, the list of criteria. Are we going to wake up tomorrow and find out that the shadow on the horizon, the black swan, was something that because of the concentration, the way you look at the world, you completely missed? But there's been a couple bits of testimony here that I need to drive into because I'm a little disturbed and concerned about some of the things I heard. The gentleman from Florida, Mr. Ross, was asking some questions about insurance. And a comment was made, and is it Matz? You actually stated on Prudential, one of the reasons they made your list, shall we say, is their derivative book. Now, was that because they didn't have enough hedging of their interest exposure? I don't know if they were doing duration exposure, but their interest exposure. And are you saying they had a derivative book, and because they were actually insuring their interest derivation exposure, that forced them onto your list? I mean, what did you mean when you said the derivative book?
They had such a large exposure that the failure of that institution or financial
When you say that institution?
Of Prudential.
No, okay. So they're buying an additional hedge to protect their interest rate exposure, so if the moves against their 100% coverage. Explain to me how that would work.
Well, first of all, the derivative position is just one position, but if they are so interwoven or so interconnected with other financial institutions that if they failed...
No, not if they're not...
I'm sorry, will the gentleman suspend? I wish to alert members that regrettably there is yet another procedural vote on the floor. I think we're drawing near to the end of the hearing, and so if members who have yet to ask questions wish to go vote now and return, I think we can keep this thing going. except for Mr. Tipton, who's next. So if members wish to go vote and return quickly, I'm sorry to interrupt the gentleman. Gentleman from Arizona is recognized again.
Thank you, Mr. Chairman. Look, we're talking past each other because, everything I know about why you buy your derivative contracts to protect your interest rate exposure, that would be something you would find joyful, not put them into a designation. Also, in looking over parts of the reports about Prudential, okay, so their repo contracts are 100% offset and collateralized. I'm just trying to figure out where you found exposure.
It's all exposure. I mean, what the assumption
If
that
you're 100% covered and you've also covered your interest rate risk, the exposure is what?
The assumption that is made in making our determination is that there is material distress at the designated institution. So we're starting from the assumption.
So I have an institution that's 100% covered, plus also done additional financial products insurance to cover markets moving against them.
But we're operating from the assumption that there's material distress at that institution. So if there's material distress, then they can cover the outstanding debt that they have or the loans that they have.
But they're contract loans. The insurance products that they're offering are all under contract. So they have the ability to say, according to our contract, you may be making a claim for this, but under the contract, we have the ability to pay as the contract is designated.
Unless they're in material distress.
Okay, I'll give this one to you in writing because we're talking past each other because that makes absolutely no sense. When I look at your Section 113, tests, and I go up and down this, I mean, is it the last one, K, other risks that the council may deem appropriate? I mean, when I look at this list, particularly on an insurer like this, which is 100% covered and then hedge their coverage, I'm trying to find out on this list, where do you find the exposures?
It's their interconnectedness with the other institutions and the assumption that that financial institution is suffering material distress. I mean, I think it's
Wow,
the basic...
I wish I had you in grad school because there'd been some fascinating questions. All right, last bit in my last 20 seconds. Mr. Curry, you're the only one on the panel I've heard actually touch something that actually made me very happy, and that was sort of the unknown, the reality that future financial markets are moving Silicon Valley Valley centric, the new ways people are going to borrow money, find credit, invest, move around. Isn't that, though, actually much safer and much more robust than a concentrated banking system because the way capital is acquired is much more distributed model?
Again, from the FSOC standpoint, we have identified as one of our emerging risks the financial innovation and migration of activity. So it is an area that we're discussing, and I think we'll devote additional attention. As the comptroller, we're very interested in this because of the impact of fintech and innovation on the delivery of banking services.
And I'm going to give you something in writing. I know we're way over time, but sure. I beg of you, if it's creating diffused risk, if we're seeing sort of a distributive model, please do not beat up innovation. We desperately need it.
Actually, I'm calling for really fostering responsible innovation.
And with that, I have to yield back. Thank you.
The gentleman yields back from a very salient point, which I think he will agree with the chairman, that just citing interconnectedness is not enough of a criteria because, and no one else from the panel I see was able to answer your question as well. My daughter's former lemonade stand is also interconnected if you go through the whole realm. So I think there has to be more substance to it than that. But with that, I will now yield to Mr. Tipton for 5 minutes.
Thank you, Mr. Chairman. And I'd like to thank the panel for taking the time to do it.
Microphone, please.
Does that work? There we go. Thanks for taking the time to be able to be here, and we've got a large group, and I'd like to be able to echo some of the comments that were made by Mr. Lucas and Mr. Stivers in regards to community banks. Something that's critical for rural America, and particularly in my district. And you've had to raise your hands simply because of the size of the panel several times here, but I would like to be able to just get a sense of your feeling on the panel. Who is concerned about the challenges faced by America's community banks and financial institutions in these small communities? Everyone has raised their hand. In the response to Mr. Stivers, you've made the comments that how much time does the council actually spend in regards to community banks, and the answers were some, or it's going to be at the staff level. And, you know, I'd maybe like to start with Chair Grinberg and maybe Comptroller Curry. If it is actually something this is in your wheelhouse, why isn't more time spent on community banks?
It actually is. I mean, the OCC, along with the FDIC, we have 1,700 banks. The majority of them are community banks. That's been a major focus of my term as comptroller, is to look at and make sure we have a strong, viable community banking sector. I think we're very fortunate to have a diverse banking system in the United States. We've looked at, and as part of our GRIPRA process, what are the burdens particularly facing community banks. We've identified some areas where we think we can make a difference, whether it's call report reform, capital reform, and what we've done at the OCC, we're really looking at, can we reduce the cost structure? So we put out a white paper a little over a year ago, encouraging from a regulatory standpoint banks, particularly smaller banks in rural communities, to collaborate, whether it's a joint venture, sharing employees, working on participation, so that they can continue to be viable entities and serve their communities.
If I may, let's talk a little bit about when you're talking about a viable, vibrant banking system. You're aware that right now approximately 1/3 of the counties in the entire United States are served by only one community bank. Do you recognize that?
Yes.
How vibrant, how competitive is that?
Well, what we're trying to do is really make sure that, and this is again the balance between what's appropriate supervisory standards and how we supervise those institutions so that they can continue to lend, to be leaders in their communities going forward.
You know, you talked a little bit about collaboration for the banks to be able to come together, to be able to share employees. What type of collaboration is going on in the FSOC to be able to identify redundant regulations that are overlapping, requiring small community banks to be able to answer to several masters, if you will, and driving up those costs, which are increasing the cost for loans for communities, inhibiting those banks' ability to be able to survive, driving actually consolidation or actually failure of some of these small banks?
I think the primary area where we're addressing that for community banks is at the Federal Financial Institutions Examination Council, which all the bank and state and federal bank and credit union regulators are part of. And that's really part of the mission of the FFIEC.
And just as a little bit more of a follow-up on this, you know, as we reviewed the FSOC minutes, there's never a mention of small banks in the minutes. And so I am pleased to hear that you are actually putting out some comments and some white papers. I think the question that our community banks would like to have answered is, when are they actually going to get some relief rather than talk?
If I may say, Congressman, I do think community banks have been a focus of enormous attention by the bank regulators who have responsibility for them.
That's what really disturbs the community banks. They have been.
And as you know, community banks play a critical role in the financial system. We've shown in FDIC studies that community banks account today for about 14% of the banking assets, but hold about 45% of all the loans to small businesses and farms by all banks in the United States. So the role they play is really quite critical. I do think that's to be distinguished from whether they pose in and of themselves a threat to the financial system that would warrant the FSOC's attention. While they're critical to the financial system, certainly can be impacted significantly by systemic risk. As we saw in this recent crisis, you know, they themselves are not a source of systemic risk, And where they are the focus, are by the bank regulatory agencies, and we, as you know, have been conducting a review as we're required by law of the regulations we've imposed over the past 10 years, have held outreach meetings across the country, are seeking public comment, and I am hopeful we'll be able to come out with a series of regulatory measures that will be helpful in terms of reducing the cost of regulatory.
I hope you can, because simply as Mr. Schweikert was pointing out when we're talking about the connectivity that's going on, while you may say and are accurate, they're not going to be systemically important to the overall economy of the United States. They are certainly feeling the impacts of those broader rules and regulations that through loan participation, whatever it happens to be, that is cascading down and inhibiting their ability to be able to address the very people that you cite, and I agree with you, are very important, our small businesses and our agricultural communities. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. Mr. Pollockman is recognized now for 5 minutes.
Thank you, Mr. Chair. Appreciate it very much. I wish everybody a Merry, Merry Christmas and a happy holiday season. Thank you all very much for being here. It's very important for us here on the committee and for our fellow Americans. Chair Matz, I'd like to ask you a couple questions, if I may. Are you familiar with the December 14th announcement by Chair White dealing with the new regulatory process dealing with asset managers? You familiar with that?
I've read about it, but I'm not intimate.
Okay, can you remember what the content of that was, ma'am? No. Okay, let me help you out. And could you speak a little bit closer to the microphone? My ears aren't what they used to be. In that, Chair White mentioned that that going forward in regulating asset managers, she'd be looking at liquidity risk, leverage as per use of derivatives, stress testing, and things of that nature. Does that ring a bell?
Pardon?
Does that ring a bell?
Yes.
Okay, good. And can you think of anything that the SEC is not doing to regulate asset managers since it's been so good at doing this for 75 years? Can you think of anything that she's left out in the new way that she's proposing to regulate asset managers?
Well, as I said, I haven't reviewed it. I'm not intimately familiar. I have great confidence in Chair White.
Okay, good. I'm going to take that as that you don't have anything to add with respect to her job in regulating asset managers. Are you familiar, ma'am, with the FSOC's decision to review asset managers' products and activities?
Yes.
You are, okay, because you voted on that. It was unanimous back in December of last year, I believe. Are you also familiar with Section 113 of the Dodd-Frank Act?
Yes.
Good, okay. There are 11 different parts of that Section 113, Ms. Matz. One of them, which deals with what you folks are responsible for in weighing whether or not an asset manager, a mutual fund, a pension fund manager, and so forth and so on, should be so designated as SIFI. One of them, and I quote, the degree to which the company is already regulated by one or more primary financial regulatory agencies. Now, the SEC is one of those primary regulatory agencies, right, from asset managers? Yes. Okay. So my question to you, Ms. Matz, is that what in the world is FSOC even doing in this business? We have a regulator here that's been doing this for 75 years. You agreed that there's nothing you can think of to add to her job, but at the same time, you voted along with everybody else to consider designating asset managers as SIFIs. So what am I getting wrong here?
We didn't vote to consider
Speak right up, please. My ears are
We didn't
bad.
vote to consider asset managers as SIFIs. We voted to consider, to have the staff look at the activities of the asset managers to determine whether
Well, that's the
those
same thing. Now,
activities-
that's our legal speaks. That's the same thing, isn't it? If you're
No.
asking the staff and you folks are going to decide whether or not you're going to designate an asset manager as a SIFI and looking at the criteria thereof, that's the same thing, isn't it?
Well, we have not made any determination.
I know you haven't. Why are you even in this business?
Because our mandate is to look at those institutions that could pose a threat to the financial
Well, she's already
stability
doing
of
that.
the United
The
States.
SEC is already doing that. I
But
just
her-
read you
her mandate is-
I just read you the criteria, ma'am. She's dealing with liquidity risk and leverage as respect to derivatives and stress testing and everything else, and you couldn't add anything else to the parade. So my question is, why don't you folks move on? You've got other good things to do. Why should you get involved in this space at all?
Well, two things. One is that we have not made that determination yet, but that the SEC is not looking at the threat to the financial stability of the United States. They're looking at the narrow securities market. Is that correct,
Okay.
Mary Jo?
Okay, let me know. I'm asking you, ma'am. Ms. Matz, I'm asking
Yes.
you. Thank you. All right, let me ask you this question. Since you folks clearly have gone down this path or are going down this path to consider whether or not you should designate an asset manager as a SIFI, you must have some analysis that concludes that what the SEC doing is not full. Do you have that analysis for me or for my office?
Well, their mandate isn't to look at the financial stability.
Do you have the analysis that you use, Ms. Matz, and everybody else used to so determine that the SEC is not fulfilling their job? Because that's dictated by
We did not come to
113.
that conclusion that the SEC was not fulfilling their job,
Okay, well, you had to make a decision based on what?
based on our mandate.
Let's move on a little bit. Are you familiar with a study done by Mr. Douglas Holtz-Eakin, the former director of the nonpartisan CBO?
A study on,
All right, you're probably not. It was done in 2014. Let me just give you the ultimate conclusion. It basically says the following. If an asset manager that proposes that represents, rather, no systemic risk to the markets or to the economy, if they're so designated as a SIFI, then the costs will go up. We've discussed this today. The product offerings will go down, and the long-term rate of return of savers for their retirement and putting their kids through college will likely go down by 25%. Now, also in 113 of the Dodd-Frank, there are other risks that you should consider. Do you folks consider the risk to the small investor, a nurse in Lewiston, Maine, or a logger in Dover Foxcroft, Maine, that are trying to save money for their retirement or for the kids' education? Are you considering the risk to them if the asset managers that run their money are so designated as SIFI and they get dinged by about 25% in their rate of return? Do you consider that?
we have not made any, even been given any potential recommendations, so we have not
Okay,
considered
so
any aspect
do you
of it.
factor in the economic cost to the people we're supposed to help in this country in making these decisions, whether or not an asset manager should be so designated as SIFI?
We're not even at that point of making that determination.
Time of the gentleman has expired. The chair now recognizes the gentleman from Arkansas, Mr. Hill.
Thank you, Mr. Chairman. Thank the witnesses for being here today. So many questions, such a distinguished panel, and so little time. Very frustrating. Chair White, if I could start with you, please. Traditionally, your testimony and in your capacity and the previously always has our famous boilerplate that says the views expressed in the testimony are those of the chair of the SEC and not necessarily represent the views of the full commission or any commissioner, standard procedure. But while this is a good disclaimer, I think, for general testimony, we do love it when you all actually give personal views occasionally and not stand on the party line. Here, in the concept of an FSOC testimony, it causes me to want to ask you a few questions. One, of course, you serve on FSOC as one of the 10 voting members. Here's my question. If one of the other 4 FCC commissioners was opposed to one or more of your FSOC positions, does Dodd-Frank require the SEC to vote ahead of the FSOC meeting to determine how you would then represent that view at the FSOC meeting?
It does not, although I do consult with my fellow commissioners before and after the FSOC meetings, but the short answer is no.
And so in that consultation, can you give me an example of where there's been disagreement between commissioners?
No, it's more just, informationally briefing on what's going to come up before FSOC, what I'm intending, and again, under the structure, I'm the member and obviously the voting member, but the member of FSOC. If there is anything to take a position on at the meeting, I convey that, and obviously listen to any, input or difference of point of view, and then afterwards report to the commissioners on, what transpired at the meeting. So, but there's not a structure to, take a vote in advance.
But if, to continue sort of the line of questioning early this morning, if you had a commissioner who was particularly passionate on a topic, would you be open to taking them to an FSOC meeting?
Again, I certainly am totally amenable to that point of view and making certain that I fully understand it and take it into account. Again, under the current structure and protocol, the chair or the head of the agencies that are the designated 10 members, voting members, can bring, a +1, as it's called in this town, to the meeting with us, which is has been a staff member. So it's really not structured to have, the other presidential appointees. Obviously, that creates some sensitivities, no question about it, attend those meetings or, vote on the matters. That's not the current structure. It's up to Congress if they want to change that structure.
Well, it just seems that internally it would be good if there was that level of disagreement where maybe a commissioner wanted to express their views directly to FSOC, that might even merit, a formal commission discussion and a formal view of the commission potentially before you simply represented the commission in your own individual capacity.
Well, one of the reasons that when I became chairman, that I tried to, change sort of how we proceeded to get fuller input was precisely that. But again, the existing structure presents some of the challenges you're outlining.
So the other thing, one thing that I've only been in Congress 11 months or so, but one thing that's come up consistently, it's why it's very helpful to have so many of you in one hearing, is this lack of transparency in the process that many in the industry feel. And yes, it's a new agency and it has growing pains and has structure to be put in place. But there's a right way and kind of a wrong way, I think, to do things in Washington. We all know the Administrative Procedures Act. We all know our obligation to openness. And in some cases, we've taken actions before we even have rules. I think somebody referenced that we've designated insurance companies before we've even set what the standards might be for insurance companies. So one thing I looked at is that in GSIFI capital surcharges, there's a very transparent mathematic, I've seen it written down, how to designate somebody for a GSIFI surcharge. And that looked very transparent to me, and yet we don't even have that level of information on routine decisions in considering non-bank SIFI designations, or even to some degree, activities-based SIFI analysis. Who wants to comment on that? Maybe Chairman Grunberg, you might comment on that, since it's both a banking and a non-bank designation question.
Well, Congressman, as was discussed earlier, the FSOC established a process for SIFI designation pursuant to rulemaking and public notice and comment. Actually, I think the rulemaking went through 3 series of public comments, and the first stage of the process, as I'm sure you know, is a set of metrics, a set of thresholds through which an institution would pass. And I must say there are a very high set of thresholds which would almost by definition be limited to some of the largest or most interlinked companies in the financial system. That is something that's any company can calculate in terms of projecting what the impact might be. And anyway, I'll stop there.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Utah, Ms. Love.
Thank you, Mr. Chairman. First of all, thank you all for being here. I know everyone is excited about the holiday season. I want to wish you all a Merry Christmas. And also to have such a great group of just so many of you here today. It's really beneficial to me as a freshman, so thank you. I've learned a lot today. I have just a couple of questions. Comptroller Curry, you stated you've previously testified that tailoring is an important tool in the OCC's supervisory and regulatory toolbox because, as you've stated, while bank asset size is often a starting point in our assessment of appropriate standards, it's rarely, if ever, the sole determinant. Do you still agree with your statement to that effect?
Yes, I do.
Okay, so when a regional bank with simple trading lending model and minimal interconnectiveness grows to $49.9 billion to 50 in total assets to $50.1 billion in total assets, what new requirements apply to that institution?
Well, there is a cliff effect if it's under the holding company under Section 165 of Dodd-Frank. So it will trigger heightened capital, liquidity, and other standards because it has crossed that threshold.
Okay, so does it make sense to automatically designate that institution even though it does not engage in trading or other complex operations?
Again, I'm the supervisor of the bank.
I know, I'm asking.
I just want to clarify. as we supervise the bank part of the holding company, we are not driven by the asset figure in terms of how we supervise that institution.
Okay, but we just determined that new requirements are applied to that institution. So I'm trying to figure out your thoughts on this and whether that designation, does that actually make sense? In terms of engaging in that type of regulatory
an asset
activity?
threshold is initial. It has some value as an initial or a first screen. So, you can make some general observations about some institutions at a certain asset size level may or may not be engaged in a particular activity. And, in my earlier testimony, our focus as a supervisor is on that particular institution, the particular activities that it's engaged in, and what the risks that those activities present. And then we deal with our individualized or tailored plan of supervision according to that analysis and assessment.
Okay, so what I'm trying to say is that the triggers automatically are applied to that institution.
Yeah,
so
that's a function.
they automatically have those new requirements. So I guess what I'm asking you is, if you think that an institution like that, without just having that automatically trigger, do you think an institution like that realistically threatened the financial stability of the United States?
Again, I think it's an individualized determination, and again, I don't think that there's any magic to any asset threshold.
Okay, so wouldn't it make sense to look more closely at some of the banks which are actually similarly situated and determine whether the designation is more beneficial or burdensome to the community in which they serve?
Again, I supervise the banking subsidiary, and that's exactly what we do.
Okay, but right now it automatically, instead of actually doing the work first to see if that's actually...
That's the effect of the statute, yes.
Okay, well, that's, I guess, the point I'm making.
Yes, I understand.
Okay. If a $50 billion SIFI threshold were raised or eliminated, could the OCC still have the regulatory or supervisory tools that they need necessary to make sure that all supervised banking organizations are operated in a safe and sound manner?
Again, purely as a supervisor, that's what we would want to see to make sure we have a safe and sound institution.
Okay, so you are pretty much saying that you would like to do that work first before it's automatically designated.
I would like essentially say that's what we do as a matter of course as a bank supervisor of the national bank.
So would you support that statute being changed?
Again, I think in previous testimony, that's really a matter for Congress to decide what that initial first threshold is. And in terms of my role as a supervisor, as the bank, and I don't want to belabor that point, we will continue to apply a risk-based focus to our supervisory activities and standards.
Thank you. Thank you, Mr. Chairman.
Time of the gentlelady has expired. Chair recognizes now the gentleman from Minnesota, Mr. Emmer.
Thank you, Mr. Chair, Ranking Member. Thank you to the witnesses for being here for so long today. Chair Massad, for you, it's good to see you again. We first had the opportunity or an opportunity to meet while I was serving on the Ag Committee. And I wanted to ask you when, I'll put it this way, I wrote it out so I do it right. Does it concern you that a regulatory body comprised primarily of banking, credit union, housing, and other regulators have the authority to intervene in markets that you, the CFTC, regulate and potentially substitute their judgment for yours in highly complex or highly technical matters?
Well, thank you for the question, Congressman. I think the structure we have is a very good one in that it brings all the regulators together, which allows us to look across the financial system, to look at emerging risks. There are issues in our markets where other regulators have certain responsibilities, whether they're things like the margin rules for swaps, regulation of central clearinghouses.
Well,
so I think it's a beneficial.
If I can interrupt you, because it's limited time, and I appreciate, I wasn't asking for the mission statement. I'm asking specifically with respect to the CFTC. I've heard all kinds of questioning today, and I've done a little reading about how the FSOC decided that in spite of the one insurance expert
voting member, they substituted their judgment in place of his. And I'm asking you, doesn't it concern you, or does it present any concern to you that this body, this regulatory body, might substitute its opinion for yours at the CFTC?
Well, I see it as a structure which doesn't so much involve substituting its opinion for ours, but rather bringing regulators together so that they can share information, cooperate, and coordinate what we're doing, and I think that's very beneficial to the overall system.
Well, let me put it to you this way. When the CFTC members meet to consider issuing a proposed or final rule or decide an enforcement matter, even though you are the chairman of the CFTC, your vote counts the same as all of your fellow commissioners, correct?
That is correct, sir.
All right, but now when you sit on the FSOC board and you take a vote that might be different from what your fellow commissioners would do at the CFTC, how is that not corrupting, if you will? Maybe that's a very strong word, but the process that we put in place or that has been put in place to operate the CFTC?
The FSOC isn't taking votes on our enforcement matters or on the rules that we're issuing, so I don't see a conflict there, sir.
What if your position on the FSOC differs from one of your 4 commissioners at the CFTC? What recourse do any of those commissioners have for your votes on the FSOC?
Well, I try to have an open door with all my commissioners and always am willing to share my thoughts and hear theirs. The structure,
So they just have to trust you?
Well, I would say that the structure that Congress has decided is one where each of us as individuals are the members.
I know what they've decided, and I apologize. I don't mean to be disrespectful, but the bottom line is they don't have any recourse other than your open door, and then they'd have to trust you to do what to change or do what they're asking you to do.
Well, I think, again, we try to have a good dialogue about all these issues, and I'm someone who likes to listen, and I try to respect other people's opinions and take those into account, sir.
Mr. Watt, Article 1, Section 7, and I'm directing this at you because of your experience, your lengthy experience, and the respect you have from members in Congress for your service here. And I'll just cut to the chase. The Constitution gives Congress the power of the purse, correct? Yes. When we look at the Financial Stability Oversight Council, how's it funded?
It's funded the way it's set up under the statute. You all have the authority to change it if you wanted to do that, but
well, let me help. It's
I'm not sure exactly what you're...
Assessments from banking holding companies managing $50 billion or more in assets are taken and placed into a fund at the Treasury called the Financial Research Fund. This money is given to FSOC in the Office of Financial Research without oversight. I've got a bill that would actually subject the FSOC and the Office of Financial Research to oversight. Do you agree with that, congressional oversight?
Well, I don't either agree or disagree. If you can get it passed, I'm sure FSOC would comply with it.
Well, I'm looking at the budget that that FSOC approved for itself in 2015. Can you tell me, sir, under non-labor costs, what is, quote, included in other support?
We got a full briefing before we voted on that budget, and I'm sure at the time I understood every aspect of it. I don't remember specifically what each category is now, but we didn't just rubber stamp that budget, I can assure you.
And would you submit that briefing to my office on request?
I think it would be appropriate for FSOC for you to make that request to FSOC rather than to me individually. I would not submit it as an individual member of FSOC.
Thank you.
Time of the gentleman has expired. Members are advised there is another procedural vote on the floor, approximately 12 minutes remaining in the vote. We have 3 members remaining in the queue, 1 who is left to go vote on the floor, so I think we can get through this and hopefully adjourn thereafter. Chair now recognizes the gentleman from Florida, Mr. Posey.
Thank you very much, Mr. Chairman. I'd like to just read a couple quotes. This is from the Wall Street Journal. For the weekend of October 28th, the bank reported holding negative $1.4 billion of investment-grade corporate bonds maturing in at least 13 months, according to the Federal Reserve Bank of New York data. The figures, which signify banks have pledged to sell more bonds than they will buy, reflect the net holdings at banks that act as a primary dealer authorized to trade billions of dollars of U.S. securities with the Fed and buy Treasury debt direct at auction. On May 1st, 2015, FINRA CEO Richard Ketchum stated, there have been dramatic changes with respect to the fixed income market in recent years. Many of them have come in the reaction of the failures and market impact coming out of the credit crisis. That has led to much higher capital requirements. The Volcker rule that limits the ability of proprietary trading with respect to bank holding companies, a range of other issues that have all had significant impact from the standpoint of liquidity of the fixed income market. And then finally, Dave Nadig, Director of Exchange Traded Funds for the search firm FactSet, said volume in the corporate bond market has dried up so much that it alone may pose a significant systemic threat. And so my question for Director Codroy, according to the FSOC website, the Financial Stability Oversight Council has a clear statutory mandate that creates, for the first time, collective accountability for identifying risk and responding to emerging threats to financial stability. While the rest of the world has identified an emerging threat to financial stability, namely regulations like Volcker Rule, Basel III's capital and liquidity standards, and other Dodd-Frank mandates that are draining liquidity from our fixed income markets, the FSOC and its chairman, Secretary Lew, has steadfastly refused to acknowledge that regulations are playing any role in creating this systemic risk. As a voting member of FSOC, what resources have you marshaled and what experts have you consulted to better understand the causes and consequences of reduced bond market liquidity?
So I think I would add that to a point that I thought made earlier was also a good point, which is that as we add structure and regulations and requirements, we should consider the effects on international competitiveness. And I also think that you're raising a fair point, which is we should consider the effects on potential liquidity in the markets, and it's been raised earlier in the hearing as well. These are the kinds of considerations that should go into the kinds of work that is being done by the FSOC and, frankly, work that's being done by the Congress. Quite a bit of the criteria that FSOC is employing are criteria that were embedded in the statute that Congress set that we're merely following, enforcing, and carrying out. But I think it's a fair point that you're making about how different requirements and different structures can potentially affect, on the one hand, stability and safety, and on the other hand, potentially liquidity. So I think it's fair for us to consider that as we go.
But what kind of technical expertise do we have on the Treasury staff to address that?
So I think we have the same technical expertise there that we have on all the other issues the FSOC is considering, which is there is FSOC staff itself in the Office of Financial Research, and from the member agencies of FSOC. There was a graph put up earlier from a GAO report, and it was used at the time to suggest that certain agencies didn't devote enough people to certain problems. But I thought was notable was when you look down the columns, the aggregate numbers of people being devoted by the agencies to address certain issues was ranged from in the 50s to in the 90s. It's a considerable amount of support. This is very high-level support. We're talking about some of the top analysts, economists, statisticians, and researchers from all of these member agencies, including Treasury and the Federal Reserve. They're the same kind of people who work on all the complicated, difficult financial issues in our economy, such as monetary policy, fiscal policy, international issues, and the like.
So essentially, we're talking about the Treasury staff then?
No, I think we're talking about staff from all the member agencies. And depending on the issue, there may be more or less staff from different parts, more banking agency staff on a banking issue, more investment regulator staff on an investment issue, and the like.
Yeah. Well, if compelling evidence is presented to the FSOC that regulations are, in fact, contributing to the illiquidity of the bond market, and thereby creating potential systemic risk, do you agree that FSOC's mandate from Congress requires it to make recommendations designed to mitigate the risk, which could include revisiting the wisdom of aspects of the post-crisis regulatory response like Volcker and Basel III?
So you're asking me to speak only for myself. This is not a consensus view of FSOC, but if that were shown to be the case, if the evidence so demonstrated, I think that would be fair game.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Director Cordray, the CFPB Ombudsman recently released her 2015 annual report to the director. In the report, it reviewed the consumer complaint database on page 28. The recommendation was made to improve the process of how duplicate complaints in the database can be identified, including a recommendation to remove the requirement that they must be verbatim to be deemed duplicate. Director Cordray, do you recognize the grave concern that this is to these companies who are stigmatized through it? They are regarded, this is regarded really as unfair attribution. Do you see the impact this is having, and particularly that there's not investigation to determine that to verify these complaints before they go to the website? What does the department plan to do and the Bureau plan to do to correct this?
So we actually just had a completed report and audit study done by our Inspector General of the consumer complaint database. It was just issued in September, so less than 2 months ago. It indicated that there were a very small number of errors in the system, and that was a report and study and investigation that we followed very closely. There are recommendations.
Is that study available for review?
Yeah, I believe it's publicly available,
Good,
been
I'll see
issued.
that.
And GAO has also looked at this over the years and made a number of recommendations to us. We're very mindful of those. We're very mindful of recommendations that you and your colleagues may want to bring to us as well. We do feel strongly that a public complaint database is an important incentive for institutions to step up their customer response.
But do you
and
agree
I think
that
they're
they
learning
shouldn't
a
be
lot from
verbatim
that.
to be deemed as being the same complaint? They don't have to be verbatim.
There are issues around the term verbatim, and I've been in discussions with that with our ombudsman, been in discussions with that with other overseers, including the Inspector General and the like. It's something our consumer response group is looking at carefully to try to make
Okay, thank
sure
you.
that they scrub that.
I appreciate
We'll
that.
be happy to give you more information as you.
Would each of you provide the committee with any FSOC documents containing or relating to communications between the Financial Stability Board and FSOC, and each body's members or staff concerning the designation of non-bank financial companies or their systemically important financial institutions or as global SIFIs? Is that acceptable to each of you all?
I don't have any, so I can tell you that now.
Nor do I.
I'm not a member of the FSB. I have attended 1 or 2 meetings, but I don't believe, I'd like to hear the question again, but I don't believe I have anything.
Go ahead, Chair.
I was going to say, I think there have been some production of documents in that vein, but I would check.
I think the basis here is one of transparency, and I think we've recognized today the lack of adequate transparency with the agencies, and we're looking to find ways to rectify that. Let's have a show of hands then, if you would, regarding your belief that FSOC's deliberations should be more open to the public scrutiny than in current practice. Would you all agree to that then? Do you believe that there should be more openness?
I think we've provided for more openness as we've been amending and changing procedures as we go.
Do you think
and
there's a basis to be more open?
I think
In light of
we-
what's been discussed today, let
think
me
we've
tell you what I have in
demonstrated
mind.
it, so,
You know, clearly, we believe that transparency is vital in our government, and I will be introducing a bill later on today that will provide a greater measure of transparency. Here are the 2 elements of this bill. First is to testify semi-annually, each of you, before the FSC and the Senate Banking Committees, and you cannot decline the requirement that it would be mandatory, or permit all members of the Financial Services Committee and the Senate Banking Committee to attend all FSOC meetings, whether or not they're open to the public. Would you agree that that would be acceptable? Do you have any problem with any of those?
If you can get it passed, I mean, we'll comply with the law. I will comply with whatever law you pass, but
But do you think that's reasonable?
I don't think it's reasonable.
Chair White, do you think it's reasonable?
I mean, I certainly think we all should be responsive, to bodies of Congress. I mean, all of us at any time we're asked, frankly, without the necessity of a bill. But I think one has to be careful.
We're just saying that, testify semi-annually or allow us to come to the hearings.
But I think in terms of the sort of the FSOC process, we have to be very careful about what it's designed to do, and that it also, the nature of the information it considers. Yeah.
Openness and transparency.
I think we should continue to look at openness for sure. I mean,
that's what it's designed for. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. Let me start with Mr. Gruenberg. The banking regulators just concluded that total loss absorbency capacity, TLC, proposal for globally systemically important banks would require banks to hold a certain amount of capital, but also requires them to issue a certain amount of unsecured debt that can be converted to capital in case of the bank's failure. However, some observers, including, I believe, your vice chair, are concerned that the proposals call for banks to take on more debt at a time that the Fed is getting ready to raise interest rates. And he says that this is a risky and dangerous proposition. Is his concern legitimate?
I think the unsecured debt requirement is an important component of efforts to make these systemic companies able to fail in an orderly way without putting the taxpayer at risk, Congressman. The experience is that when a financial institution fails, all of its capital, all of its equity is wiped out. The only thing that remains is the debt held by the firm, which is then available on a closed institution basis after the institution fails to be converted to capital so that the private creditors of the failed company bear the losses for managing the failure of the institution. And as it turns out, most of the large financial companies in the United States, most of our G-SIFIs have substantial amounts of unsecured debt. The rule that the Federal Reserve has proposed would ensure that they maintain a minimum amount. So if they get into difficulty, they can fail, and it's the private creditors and not taxpayers that put on the hook. And so for that reason, I think the proposal has merit.
Thank you. Let me jump to someone who I'm used to seeing sit up here. It's still funny to see him sit down there. That's the Honorable Mel Watt. In recent weeks, the debate over what to do about the mortgage giants Fannie Mae and Freddie Mac have shifted from wholesale replacement to genuine reform, as replacing Fannie and Freddie is the political environment seems more unlikely. It seems like though, just replacing them is completely unlikely. We all want more private capital in housing finance, but my question is, do you believe there is enough private capital to fulfill the role the GSEs play without raising mortgage rates substantially? And what are the challenges and lessons you are experiencing as you get more involved in the risk-sharing mechanisms?
Well, we've tried out a number of risk-sharing mechanisms, trying to transfer as much of the risk to the private sector as possible. We are concerned that the private sector, the capacity of the private sector to take on this risk, particularly in an economic downturn or a distress situation, would concern us greatly. If the entire system were converted to the private sector, you would have that risk of not having a backstop during a downturn, and you would have the risk of, I think, of increased cost to borrowers, both of which I think would need to be evaluated by Congress as they evaluate how to move forward.
Thank you. I got to see, I've got a few seconds left, and I got one other question. I would have loved to have gone back. Let me just try to ask this question real quickly to the Comptroller, Mr. Curry. Amid regulations and supervision, the good news is that we are starting to see banks taking bolder steps to reduce risk and exit out of certain risky activities. On the other hand, it seems that these raises concerns because some of the activities are just shifting to less regulated shadow banking entities, and that banks are getting out of certain communities and in certain countries. And so are we denying services to millions of lower income Americans, not because the risk is too high, but simply because the profit margins are too low, or not as high or too low?
To my knowledge, there's no evidence of that, Congressman. It is something that we would assess in the course of our compliance examinations for the Community Reinvestment Act.
The chair recognizes the gentleman from South Carolina, Mr. Mulvaney, for 5 minutes.
I thank the chairman. I thank the panel especially for sticking around. It means a lot to us that y'all don't put hard stops on us, and it lets us have some flexibility and do this throughout the day. Also apologize for having to run in and out during the day. We're evidently having serial motions to adjourn. Mr. Watt, you can explain to me why your side is doing that later on. It has to do with guns, I'm told, believe it or not. Anyway, not my...
I generally couldn't explain it when I was here, so I certainly can't explain it now.
I hear you. I want to go back to something that Mr. Green said early on in the hearing today. He mentioned the MetLife lawsuit and talked a little about the jurors and said, you know, those folks don't have to have any particular insurance experience, don't they? And of course they don't. That's not the way our legal system works. And then he sort of looked at you and asked you if you agreed with that. And I think everybody sort of agreed that jurors don't need to have that. But that's not really the standard for the members of this group, right? Does anybody really think that 10 good persons and true could serve in this role, or is it a good idea to have, I think everybody agrees we should have some expertise, right? And that's why you're there. And that you couldn't do this job if we just randomly picked you off the street. So I didn't want people walking out of here thinking that the standard for you folks is the same as the standard for a juror. And I want to go into something that I believe Ms. Mott said to the chairman early on about the process you went through in your decision-making regarding MetLife. You said that you were briefed extensively, which I want to talk about a little bit. You said it was done by the FSOC staffers. Let's talk about that. Was this to you individually? Was it to you and your staff? Was it to you as a group? Tell me how you were briefed on this, Ms. Motz.
I was briefed by my staff, who participates actively with the FSOC staff and the FSOC Deputies Council, and then we were briefed extensively as a council, and we also received a great deal of briefing material.
Gotcha. All right. The final determination was made June 30th. Do you remember the first time you were briefed on MetLife?
I don't.
Was it days in advance, weeks, months?
Oh, no, it was a long, it had been in the works for probably a year or more, probably more than a year. So no, we were briefed on progress and on consideration, so I couldn't tell you when it was, but the staff worked on that designation for quite a long time.
So the staff worked on it, and I get that, and we do that here as well, as Mr. Watt would tell. We rely on our staff a lot. But how much time did you spend on it yourself?
I spent a long time because there was a tremendous amount of information both to get in briefings and reading material. The basis was, I believe, 300 or some odd pages.
Okay.
So
did you block off times during the day for reading those materials?
Brought them home. I read them marked up time at night and on weekends.
I do the same thing. I do the same thing. Let me ask you this then. And the reason I'm focusing on you is you mentioned it during your opening statement. I think you also mentioned it to Mr. Holmgren in response to some of his questions. Given your extensive briefing on the material and the understanding that the statute requires you to look at 11 different factors, I want to go through them very, very briefly. For example, you mentioned in your opening testimony or in response to the chairman that you did look at, one of the things that stood out in your mind was the derivatives. That was one of the things that stood out in your mind as to the MetLife, in making the MetLife decision or voting for the designation. So tell me what it was about the derivatives that you thought was important.
We just can't discuss that right now because it's in litigation. So we have public information on the FSOC website, but we're not at liberty to discuss the details of the deliberation.
Okay, let me ask you this way then. I disagree with that, by the way. We get that a lot. Mr. Watt didn't allow it when he was here, and I don't like it now that I'm here, because you can tell us stuff, but we'll skip it then. You made the same determination for Prudential, right?
Yes.
And you voted to designate them, and they are not in the lawsuit right now. So what was it, I take it you did the same level of preparation in making your decision for Prudential that you did for MetLife?
Correct.
So what was it about the derivative position that Prudential had that made you inclined to vote for the designation?
Well, it wasn't just one item. It was the totality of
I get that.
their
Tell me one thing
exposure,
about their derivative position.
the size of it, and I can't remember off the top of my head, but it was a huge amount of derivatives and exposure.
Huge in relation to what?
In relation to other institutions, how they were exposed to other institutions and exposed other institutions.
No, that's not my
to their
question. Huge in
threat.
relation to what? The size of their assets? The size of the
Their exposure. It wasn't in relation to the size of their assets. We view it in relation to their exposure to the financial system of the United States.
Within $1 billion, what was the size of their derivatives?
I don't know.
Thank you.
Gentleman's time has expired. The chair, I'm Luke Messer from Indiana, now recognizes himself for 5 minutes of questions. You know, it's a fundamental American principle that in America we follow the rule of law. And for the rule of law to be meaningful, of course, it has to be transparent. It has to be written down. People have to have then the ability to understand the law and see with whether they're complying with it. I want to talk about that principle in the context of the FSOC's current approach and designated non-bank financial institutions, particularly insurance companies, under that designation. Under the rule of law, folks first ought to understand why they're being regulated, what are the standards we're applying to determine whether you'll be regulated, and then how they'll be regulated. What are the standards you'll be held accountable to if you are designated a non-bank SIFI? Mr. Woodall, you've been very patient today. I have to concede, you know, for all this Kentucky Phi Beta Kappa, this is, of course, a panel full of Phi Beta Kappas and Ivy League decorated folks. I'll admit something I rarely admit in public, which is I'm Phi Beta Kappa. But I'll tell you, you know, for this complex world of acronyms and initials and regulatory structure and laws, I think like most Americans, it's all Greek to us and we're trying to figure it out. In the construct of the rule of law that I talked about, Mr. Woodall, I've offered legislation that I think is really a modest proposal. It's H.R. 3857. And here's what it does very simply. And I'll read it here to make sure I'm getting it accurate. The bill would simply prevent FSOC from designating any further non-bank financial institutions for heightened Fed supervision until 90 days after, first, the Federal Reserve establishes prudential standards for non-bank financial companies as required by Section 165A and B of Dodd-Frank. 2, the Federal Reserve promulgates regulations setting forth criteria for exempting certain types of classes of U.S. non-bank financial companies or foreign non-bank financial companies from supervision as required by Section 170 of Dodd-Frank. And 3rd, the FSOC reevaluates within calendar year 2016 each previous SIFI designation and rescinds any such designation if it determines that the non-bank financial company no longer meets these standards for designation that have been brought forward. Just would like to get your reaction. Would that legislation prevent FSOC from doing its job?
I was waiting to see what the question was going to be. Would it prevent what now?
Well, FSOC from doing its job. I mean, again, does that seem like a reasonable proposal that companies that will be designated or entities that are designated non-bank SIFIs have some way of understanding why it is they're designated that way, and of course then an off-ramp that would allow them to determine the
Yeah, well, that was your third point. And
Yeah.
it seems to me that that's what we're working for right now, is to try to get more clarity in what that exit ramp is. I've just recently submitted a list of 17 different options for the FSOC to consider. It's now being considered by their deputies as ways to clarify that, where it can be, you know, much more clear to the company what it needs to do. as I've said several times before, the company says to the regulator, tell us what we're doing wrong and we'll fix it.
Yeah. Is there any way you can provide that list of 17 to the committee?
Yes.
Thank you. I guess I will open it up to the rest of the panel. Could someone give me the rationale for designating non-bank entities, SIFIs, before establishing any public standard for doing so? And question two, before establishing the criteria that they will be held to?
I think, Congressman, I think the criteria by which we designate were set forth in the statute. And they were further spelled out as far as the procedures in our rules, which were subject to notice.
So you're telling me you believe that the entities that are being designated SIFIs understand the standards by which they are being evaluated?
They are.
Every entity I took to says they're not.
They are publicly available, and I think we also provide memoranda to the company prior to the designation.
Any others? Thank you. Seeing no one else in the queue and no further questions, I thank the panel for their stamina and for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. The hearing is now adjourned. Thanks, sir.